Folks, good morning and welcome to the 7th meeting in 2014 of the Finance Committee of the Scottish Parliament. Can I just remind everyone present to please turn off any mobile phones or other electronic devices. Our first item of business is to continue our Stage 1 consideration of the Revenue Scotland and Tax Powers Bill. Today we will take evidence from the Institute of Chartered Accountants of Scotland and the Chartered Institute of Taxation. I therefore would like to welcome to the committee this morning Elspeth Orcherton and Charlotte Barber of ICAS and John Whiting of the Chartered Institute of Taxation. Now I understand that there's no initial statements from you because we have fairly extensive papers which all members will have read, absorbed and be prepared to fire questions at you. But as normal, I will start off with a few initial questions, and I'm going to go straight to one of the nubs, I think, of what our deliberations are going to be today, and that's the general anti-avoidance rule. I have to say, your papers are so detailed, I think I myself could spend the full 90 minutes going through it, but obviously colleagues around the table will want to have their say, so I'm not going to abuse my position as the chair. But in terms of general anti-avoidance, I mean, ICAS point out that in their view the bill lacks balanced safeguards. You talk about one of the main purposes, says CIOT, is result in a very low threshold for determining that a tax avoidance arrangement exists. I mean, clearly your organisations provide advice to people on how they can actually reduce their tax bills, I would suggest. So surely the point of the bill is to try and do the opposite. What we're trying to do is ensure that people pay their fair share. And what we want to try and do is have legislation which ensures that the general population accept that there is general fairness. Because I think there is real resentment in society. I mean, if you're a nurse or a bus driver, you know, or a postman, that's someone who's earning 10 times as much as you might through use of certain tax legislation, pay a much smaller proportion of tax than people in the kind of professions that I've mentioned. So, in terms of the changes that you're suggesting at both organisations in the bill, what would be the outcome other than a reduced tax take to the state, which would obviously mean fewer potholes getting fixed, less money in the NHS ultimately, etc. How does your position on this anti-avoidance rule create a balance whereby people pay what they should pay, but at the same time they pay a fair share?
Perhaps I can start on that one. Just to state our position, you're absolutely right, Convener, to say that our members give advice in practice, but as a body we exist, we're a charity, we're constituted that deliberately so that we are here to act to improve the tax legislation, to get better tax legislation for the benefit of all involved with it, and that means taxpayers, the authorities as well as practitioners. Our aim with the comments we've made is just simply to improve certainty, and I think that's perhaps the key thing that we want to achieve with any amendments to the rules. It's obviously completely up to the Parliament, up to Revenue Scotland to decide how they wish to frame the legislation in terms of a general anti-avoidance rule. As you well know, the UK has gone down the route of a general anti-abuse rule. But however you do it, one of the things that people, and we mainly have in mind businesses here, will say, looking at it, is if I take a particular course of action, do I know that I will or won't be within the ambit of these provisions? And the worry is that if it is uncertain whether I will or won't, then people might decide not to do something, and that can be damaging to business confidence. And really it's just as simple as that, trying to improve the level of confidence and certainty that people know where they are. And to give you a facile illustration, the one I always test out provisions with is whether, if you were to come to me and say, I'm thinking of starting in business. Should I act as a sole trader, a partnership, or a company? Those are decisions that are many commercial issues around as to how you should operate. They also, of course, have tax consequences. Now, what I would like to be sure is that there is no risk if I say to you, Mr. Gibson, I think you should operate as a company because of these circumstances, or as a sole trader because of those circumstances. I would not want to have any risk that the general anti-avoidance rule might come along and say, there was a tax benefit in you going one route or another. Therefore, I have to say, possibly to you when I'm advising you, actually, I don't know whether you would be affected by the GAR. So it's as simple as that. I'm aiming for certainty and knowing where I am, where you are as my client, you know what the results will be.
Obviously, I'm keen to hear from ICAS as well on this important issue, but surely the point of not having certainty in kind of tablets of stone, if you like, is the fact that it means that interpretation does have, there's some room for interpretation. It's not quite as wide as I think you suggested, because we all know of a very famous case a couple of years ago when I think everybody, every layperson looking at the case would suggest that there was clearly a deliberate attempt to avoid taxation, but because the legislation was so specific, the two-thirds of the judges looking at this high-profile case decided that that the law, if you like, had been followed to the letter, although quite clearly the spirit had not been. And I think there's an issue there about having tax law that's so clearly defined that, in fact, what it does is it makes it easy to then get around that, whereas having less certainty to a degree does allow interpretation of what is intended rather than what the absolute words on a piece of legislation state. Do you not think that's what is trying to be achieved?
I think that is a very fair point. And I mean, we as a body have great concerns about the way detailed anti-avoidance legislation has been piled upon more and more and more. And you're absolutely right. What is sometimes the case, and I don't know the exact one you're thinking of, but the disguised remuneration legislation is sometimes cited as a good example of that, which exists to police things like employee benefit trust, which of course is a sensitive issue here in Scotland, I know. And the problem with the legislation is it has become so detailed, people start to look for loopholes in it, and you end up with exactly the sort of problem you're alluding to. We as a body think there is considerable merit in looking far more at principles-based. So the legislation is expressed as this is what it's aiming to do. You couple that with good guidance that says this is really what it means, and as we've alluded to in our paper, what we might term dynamic guidance. So it's guidance that's kept up to date in the light of experience. It's not allowed to just lie there and grow whiskers. And that, I come back to it, helps create the area of, I know where I am, I've got certainty, I know what the legislation is aiming at and trying to, frankly, stop me doing. It's trying to stop me avoiding tax in this way. But equally, I know that I am not going to be tripped up if I go down what to me is a perfectly good commercial route for good commercial reasons. But I'd better let ICAS say something.
Indeed. Yes.
Thank you. I mean, I think I would start by saying that certainly the press and media coverage over recent years, sometimes in relation to the case you allude to, I heard a slightly different case in my head. It wasn't EBT's. That it's become, I suppose, a general expectation that everybody's at it was a phrase that was once used. The vast majority of our members and the vast majority of the time that I spent in professional practice for 25, stop counting, years, was actually trying to explain to clients what the law was. If they did a transaction, what was the answer? And we're not seeking to keep open any particular route to tax avoidance. What we're aiming for is to be able to be in a position where there can be certainty in transactions. And that's really why we're wanting to look more at what is in the current drafting of the GAR. We have a committee within ICAS of members with significant commercial and business background looking at this Scottish Taxes position. And their concerns are quite genuinely expressed that if there isn't more certainty given, businesses looking at undertaking property development or transactions or investing might actually, in the absence of certainty, take their business south of the border rather than be in Scotland. So there is a certainty point that we think there is room to improve on. In terms of the safeguards, our concerns were really about the extent to which Revenue Scotland, which as yet is an unestablished and unstaffed body, would appear to have the right, almost the delegated right, to decide whether a transaction, one of the tests was, lacked commercial substance. They would be the writers of the guidance that would then have to be taken into account by the tribunals. So to a certain extent, they would have the right to say exactly what was commercial and what wasn't, despite the fact that, with all due respect to them for their technical expertise, it's not a commercial background. So the type of balanced safeguards we wanted to see was to make sure that if there is a test of commercial substance, there were those with commercial experience involved in that decision-making process. I think it might be helpful to say to the committee that we did meet with the Scottish Government team earlier this week, and I would like to hope that the door was open to go back with some constructive suggestions as to what might be possible, both in terms of adding a definition or further definitions into the GAR, or alternatively looking at a clearance process that might help to deal with the issues of certainty or fear of lack of certainty without necessarily giving rise to the concerns you've expressed, Mr Gibson, that this is all about the tax avoidance industry, which I think would be misplaced.
Well, I mean, Revenue Scotland's role obviously is to optimise tax revenue. It's not to maximise tax revenue, but it's to ensure, I think, fairness across the board. I mean, you talk in paragraph 23 of your submission about reasonableness has been criticised as being too subjective. And again, you talked about the bill lacking balanced safeguards. I assume you would suggest taxpayers or a proportion of taxpayers, I would suggest. What, incidentally, page 36, you talk about scheme promoters. What actually is a scheme promoter?
Sorry, I don't have your page numbers in front of me.
So I've got paragraph 36. You say that you talk about disclosure obligations on taxpayers and scheme promoters. What is a scheme promoter?
Sorry, yes. This was addressing the issue of whether there would be an equivalent of the disclosure of tax avoidance schemes provisions that exist at HMRC. It's a separate regime requiring what are defined by UK law as scheme promoters, avoidance arrangements, and those suggesting or recommending them are required, are under an obligation under UK law to make formal disclosures of that to HMRC. It is my understanding now from recent discussions with the Scottish Government that that route is not being taken forward in Scotland.
Okay. Now, first ICAS and then I'll go on to CIOT. In terms of investigatory powers of Revenue Scotland, it's suggested by ICAS that the suggestion of policy memorandum that to extend protection beyond the legal profession would unduly hinder efforts to tackle tax avoidance in Scotland is unsubstantiated, misplaced and anti-competitive. So I'm just wondering, how much is avoided and how would extending this protection unduly hinder these efforts?
This was a quote from, and I'm quoting there deliberately from the Scottish Government description. I think it was in the policy memorandum. I think that quote is unsubstantiated, simply because we haven't really seen any evidence that it's the non-legal profession that on its own, within the remit of giving tax advice, are the great promoters of tax avoidance in Scotland. But what you're actually looking at is what would, I think you're saying, is hinder tax avoidance in Scotland. What most of our members do on a daily basis is help people meet their tax obligations. The reasons people seek tax advice is because generally they want to comply. They don't understand the rules. They don't necessarily come into contact with the rules on a regular basis. They haven't the time to develop the expertise. They haven't necessarily the comfort they can develop the expertise. So they go and ask someone who knows the answer. And in undertaking both the advice to these individuals, assisting them with their filing obligations, reminding them of their payment obligations and of all their legal obligations, in the context of those, the tax advisors, such as members of our institute and John's, being governed by a professional code of conduct, which does cover legal and ethical issues, then most of what they do is nothing to do with tax avoidance. It's what tax liability am I going to pay?
To be honest, I think that's a very good point that you've actually made, and I think that is an important point to make to the committee. I mean, I don't want to over-egg the pudding in terms of GAR, but obviously when we're talking about these piece of legislation, we're obviously looking at the margins and where changes could and should be made. But I think everyone would genuinely accept that that is the basis of what your organisation actually does. Now, just to Mr Whiting, there's a real issue here which obviously is concerned to your own organisation, which is about the issue of client confidentiality. And I mean, you've said in your submission, a tax advisor may have no formal qualification and not be subject to professional regulation, but those who are members of one of the accountancy institutes or the CIOT are qualified and regulated. But I think but do you actually think that extending this kind of protection beyond the legal profession is in the public interest, and could you explain why you think it is in the public interest?
I think our basic point is, at the moment, there isn't a level playing field. And our argument is really, what is in the public interest is that the public, and to be honest, I think it's in Revenue Scotland's and the Parliament's interest, is that people who want tax advice are free to go where they wish and to get the best advice they can. And I would wholly associate myself with Elspeth's comments about why people seek tax advice. It's all those sort of reasons, including, frankly, that they've just got better things to do. You know, you and I could do plumbing, but I've no doubt we choose not to because we'd rather do other things. So for all those sort of reasons, it's in everybody's interest that if somebody wants tax advice, they're in a position to go to the best, a level playing field, and indeed to people who are well qualified to give that tax advice. Where we are at the moment is the way privilege operates is that there is a certain amount of additional protection, shall we say, in certain circumstances, particularly for advice given by lawyers. Does that hinder people seeking the right advice? Well, in some circumstances, it might, as we've alluded to in our paper, push somebody to take advice from a lawyer because then they know that the advice they're getting can never be disclosed, be it to Revenue Scotland or anybody else. Now, does that get to the right position? I'm not sure it does. Are we arguing that privilege ought to be extended to everybody blanket? No, we're not. We are trying to highlight the fact that there is an unlevel playing field, that it's in everybody's interest that if you want tax advice, in the same way as if you want an expert plumber, you get somebody who is properly qualified and regulated. And therefore, we think that if there is an argument for some form of privilege, it should attach to certain circumstances and to anybody properly qualified who gives advice in that sort of area.
Some of the tax advisors are not qualified, as you've accepted in your submission.
Yes, and in many ways that's quite a concern. I mean, if you look at the statistics, there's approximately 30% of those who act as advisors do not have a professional qualification, or at least have a qualification that isn't of a standing, if I can term it that, as ICAS, our own, or whatever, which subscribes to professional rules, practice guidelines, professional conduct in relation to tax, disciplinary boards. If we're in practice, we have to have professional indemnity insurance, all the paraphernalia that you would expect of a good professional. So that is a continuing issue. I don't have an obvious solution for it, but I just, we have to flag it up, and all we can do is to make sure that our members are properly trained, properly kept up to date, subject to a proper code, and disciplined if they do not meet the proper way of operating.
How often are people disciplined?
I don't think I've got one in my bag, but I mean, our monthly magazine, Tax Advisor, reports the results of the Independent Taxation Disciplinary Board, and I'm not proud to say there are always cases being reported, and I know I'm also a member of ICAW. They have about 4 pages in most monthly magazines. I'm not sure whether ICAS has people being disciplined. I'm sure you do. We're not proud of it, other than the fact that it shows that we do discipline those who fall short of standards.
I'm going to let my colleagues in a wee minute. Just one further point. Sorry, you want to say something, sir?
I'm simply going to comment on ICAS regulatory regimes, because I worked with them for a while, and all our members who are in practice need practising certificates. There are monitors that go out and check the way the practices are conducted and report back regularly to the Practising Certificate Committee. There's, just like John, you don't want to say that there's lots of people being disciplined, but there is a strong regulatory regime around all the activities of our members in practice, and I think it is a well-regulated, well-functioning system.
Thank you. Now, just one last point on extending privilege. It would obviously benefit the accountancy profession vis-à-vis the legal profession, but how does it benefit the public necessarily? Is it just by, in your view, widening the choice? What are the benefits to the taxation system?
I'll happily take that. I think widening the choice is probably where it actually sits. I think I mentioned the last time I appeared that this has not historically been a great issue for the accountancy profession, for ICAS members, but it has gained prominence recently in 2 situations. One was, and I think we've heard the submission before, a Supreme Court case involving Prudential, I think was the name it was listed under, where this was discussed at, obviously, by the Supreme Court judges, and they opined that they felt the law was requiring to be addressed in terms of the imbalance that only legal services, only lawyers could have legal privilege on tax matters. Yet in the UK, the vast bulk of tax advice is actually given by people who are not qualified lawyers, mainly the accountancy profession or tax professionals as members of John's Institute. The second area in which it has come much more to the fore is the extent to which in publicity and marketing material, particularly from the London legal firms, they are advertising the fact of confidentiality of legal privilege as a route to why anyone seeking advice would want to go to them rather than elsewhere. And I don't think that used to be a feature. I don't recall that being a feature of a few years ago. But it's the kind of topic you wouldn't necessarily want a game played round. And one of the straightforward methods, perhaps, of addressing it is to do what we had suggested. It doesn't mean it's the only solution, but to go the way of the rest of the UK, which is in respect of particular information powers at an early stage of an inquiry to keep the playing field level.
Okay, thank you.
If I can just add a brief comment to that, and I completely agree with what Elspeth's saying. We have seen some circumstances where some schemes have been devised, out-and-out avoidance schemes, under the cloak of privilege by lawyers, and have tried to resist disclosures of papers to the tax authorities because they can shelter behind privilege. That's obviously a risk, but I just point to it as how potentially this is not operating in the right way, and really we feel, as it comes back to it, the answer is levelling of the playing field, coupled with a certain amount of education about the value of going to a properly qualified advisor if you want proper advice.
We'll open out the session to colleagues now. It'll be Jamie first, followed by Malcolm.
Thank you, Convener. I'm going to stick on this issue first, if I may, because I do think this is actually quite important. I think the answer that Mr Whiting gave there at the end demonstrates why this is important and we get it right. But my first question, and Elspeth Orson's kind of answered it already, but I mean, on a practical level, how big an issue is this? You've already said this isn't historically a big issue for the profession. I suppose the question is, does this actually harm accountancy firms? Are they struggling as a consequence of this? And I refer to your own point. The vast bulk of tax advice is still given by people who aren't lawyers but other professionals.
I think someone's going to tell me they've never seen a starving accountant, but that's not quite the point we're getting at. We do have the situation where the giving of coherent tax advice, which does sit within, primarily within the accountancy profession, can be interrupted. And I think if you're looking for people to make their fair contribution and to understand what their fair contribution is, you really don't want that conversation with an accountant interrupted by a lawyer jumping up now and saying, well, you should come to us because this bit's slightly different. It's not a massive issue for most of our members at the moment. I see it becoming an increasing issue. And the timing, of course, of us having this conversation is presented by this bill coming forward in the light of the other case law that's come up. And it is a matter, we believe, for parliaments. The Supreme Court said that to both, I think, the Scottish Parliament and Westminster, and that's why it's on the agenda.
We had the bill team, I think it was last week, one of my colleagues will correct me if I'm wrong, and they were pretty clear that this, it's not wide-ranging privilege that lawyers have, it's pretty tightly defined, and I think they also suggest they might go away and reflect on the evidence that we gather at stage one, and if it needs to be further tightly defined, they'll do that. I mean, would you welcome that? I mean, from what, I think it was yourself, Mr Whiting, you were saying that they were using privilege as a guise to devise avoidance. I mean, my understanding of this power of privilege, for want of a better term, that's not what it's there for. If this can be more further tightly defined, would you welcome that?
I would welcome it, yes, and that's very much what we would like to see. As Elspeth alluded to, the Prudential case, which we were involved in, sort of supporting the arguments, as it were. Really, our objective is to get this issue looked at properly. We believe it is a matter for Parliament, here or in Westminster or both, to look at and decide, really to answer the question, what do they want privilege to apply to? Because my own belief is that privilege is basically it stems from a time when, if you are accused of a crime, you, the accused, could not speak. Your lawyer was the only one who could speak for you. And of course, naturally, you needed privilege so that your communication with your lawyer, who spoke in effect your words, was protected. Well, if that's what privilege has basically come from, I'm not entirely sure what it's doing, sort of regulating how tax advice is given. And it's that makes me feel this whole area needs looking at and deciding what is it that should be privileged. And I still keep coming back to the idea that what we should be getting at is, in certain circumstances, privilege should apply no matter who is giving the advice, because it's in certain circumstances that it's in the interests of everybody that they get proper advice. I mean, I might point to a situation whereas if somebody gets very behind and seriously in arrears and they have serious problems with their tax affairs, it's in everybody's interests that they make a complete clean breast of it to their advisor, who then helps them to get up to date and regularise their position. One might say that you want no worries about disclosure of what is said in those circumstances. Obviously, the good professional will use the information given properly, but it's that sort of situation that you might want to say, right, privilege applies because we just want everybody to feel able to give proper advice and to get the person up to date.
Okay, I think that's probably something we need to look at a bit further. Mr Whiting, your organisation is concerned that some mass have been left for secondary legislation, and some rules should be part of the primary legislation. But I mean, obviously, it's a more arduous process to amend primary legislation that is secondary legislation. But secondary legislation is still subject to the scrutiny of this Parliament. So I'm not quite clear what is the concern here.
It's one of those questions of balance. As a matter of principle, we always prefer rules about tax in primary legislation, but at the same time, we freely accept you can never put everything in primary legislation. You're going to want secondary legislation, particularly about administrative matters, and for that matter, you're always going to want a certain amount of guidance, because however carefully you write the legislation, and I think that, let's be clear, the Bill team have done a very good job in writing clear legislation in this bill. But you're still going to want a certain amount of guidance to help people know what they are. So you might say there's going to be 3 levels here. What our concern is that what should be in primary legislation is the real rules. And I think where we home in on is a certain amount of the penalty provisions, where penalties are a fairly key part of legislation. Taxpayers should know when they're going to be penalised, and I fully accept what you're saying, Sir, in terms of secondary legislation is still subject to parliamentary scrutiny, but we think something as key as what penalties should apply should be in the primary legislation. Secondary, yes, how are the penalties actually mechanically going to be applied, but the circumstances of the penalties should essentially be in primary, together with the very welcome powers about how they can be mitigated, when they can be suspended. It's just that whole area of the penalty regime which is pretty fundamental to the fairness of the tax system, and we would have thought that Parliament would really want to be sure that they were being fair.
But why wouldn't taxpayers know where they stood in relation to penalties just because it's through secondary legislation? I don't really see why they wouldn't.
I mean,
to be perfectly frank, I would imagine most people out there really don't know the difference between primary and secondary legislation.
Absolutely fair challenge, and you might take it a stage further and say, would they really mind if it was just in guidance? And I think it's a matter of principle. I can accept your point, Mr. Heban, in terms of practicality, that the taxpayer at the end of the day doesn't really know whether it's primary, secondary or guidance. I just feel fairly strongly that for something as key as this, it should be primary. But Charlotte, you...
I was just going to comment that I feel really strongly, I think ICAS members feel really strongly, and have long said that principles should be in your primary legislation. And I think one of the difficulties with tax is that often a lot of it's very detailed, and you tend to think detail, secondary legislation, pop it in the regulations. Whereas in actual fact, an awful lot of what you're working with is the detail, and the detail do constitute powers. I think your principles should be in primary legislation. Those principles are the powers. What can Revenue Scotland do? If it can raise levies, penalties, interest, those are powers, and they should be up at the top. If you look at what the penalties in particular are for, it's for promoting compliance, it's for forcing compliance in a self-assessment system. So the penalties are your main tool, and in any appeal system that you see, people, when they get hit by the penalties, usually come back to whether they're fair or not fair. And coming back, Convener, to your points about fairness, I think so that those who've implemented the legislation can hand on heart sit there and say, this is a fair system that we've actively considered and put in place to encourage compliance in a system where the taxpayer really has the onus on him to do it himself, should sit amongst your main principles up in the primary legislation.
I mean, obviously, whether secondary or primary, it's still got effect in law. So, you know,
It has.
I'm hearing you all saying it's, you know, it's a high principle in this, but I'm not really getting the sense of why it's such a high principle.
I think in terms of how you structure legislation, then primary legislation, your first port of call, should say what powers are being awarded, and awarding a penalty to a taxpayer is giving a power to Revenue Scotland, and therefore I think it's really important that the details of it, the amount, when, why, is all put in the legislation at the top. I think it's really important that Parliament considers that. I ought to declare an interest here because I sit on the First Tier Tax Tribunal. We hear lots of cases about penalties, and 9 times out of 10 the questions are over the fairness of the penalties. Well, that's not for the tribunal or the taxpayer or Revenue Scotland to decide upon. That sits with why the penalties have been legislated for. And I do accept secondary legislation comes before Parliament, but I don't think it's as actively discussed and deliberated as part of the full package of how you're forcing your citizens to comply.
That depends on whatever committee it's before. It's up to them to look
Yeah.
at it rigorously. Can I ask, again, the Chartered Institute of Taxation, you noted the contrast between, in the Charter, the contrast between what Revenue Scotland should aspire to and what's expected of the taxpayer. And again, this was raised with the bill. I mean, I think, to be fair to them, they accept it could be better framed. So, I mean, you know, what was the concern? And, you know, if there is that offer that they could go away and look at it and maybe word it better, how could it be worded better in your...
Which is very welcome news, and I'm aware that they are going to have a think about it. I mean, we are great fans of Charter. We've been involved in a project around the world of sort of trying to develop model charters, and we see these as very good demonstrations to ordinary taxpayers of how the tax authority will work, what responsibilities there are. It's all part of building confidence in the tax system, but at the same time it's also a good means of communicating to taxpayers how the whole thing will operate. So it's a very much a two-way street, rights and obligations on both sides, and to have confidence in the Charter and to make maximum use of it, it must be seen as saying what the tax authority is expected to do. So we certainly were keen that it does talk in terms of excuse me, expectations on both sides. We also think that the Charter is something that should be regularly reported on, an obligation to for Revenue Scotland, possibly signed off by the members of Revenue Scotland, I think probably signed off by members of Revenue Scotland, to lay a report before this Parliament on how the Charter is going, and observations both as to how the tax authority is operating and how taxpayers are responding to it.
I think I took from that, essentially, there should be some sort of equivalence in terms of the standards for the tax authority on one hand and taxpayers on the other.
It is rights and obligations on both sides, and it is a good way of communicating it, because to almost come back to your previous line of question, Mr. Hepburn, it's taxpayers are not going to look at legislation, be it primary or secondary, but a charter which ideally can be communicated in a poster, in a pretty short and brief document that is part of the statement about how the tax authority is going to treat you, but at the same time what we expect from you. You are supposed to do this, but in return we will do that. It's a pretty powerful means of just building a good rapport between taxpayers and tax authorities and making sure everybody has confidence in how the system will operate.
Yeah, I take that point. I think that's well made, Convener. Thank you.
Okay, thank you. Malcolm, to be followed by Joan.
Well, I was going to ask about two areas, the GAR and the Charter, but I think the Charter has been substantially covered by the last series of questions and answers. And I think, to be fair to the Bill team, they have indicated movement both on consultation, which was one of the concerns, and it seems also around the language of aspiration. So I certainly agreed with everything that John Whiting said in his last contribution. So I hope that those changes will be made, because I think that would help to give some confidence on the part of the public about Revenue Scotland. I mean, I suppose some of your concerns about the GAR are possibly that, again, the position of Revenue Scotland is not quite right, because perhaps they're being given too much discretion, and too much is going to be in what they decide is reasonable, and so on. So I would mainly like to ask about that. I mean, I must say I did find some of your evidence a little bit persuasive on that, because I think various people over the last few weeks have mocked the double reasonableness test, but through reading your evidence, I did come to think that perhaps the double reasonableness test was actually quite reasonable, because I mean, I take the essence of it is that there is an attempt to have some kind of objective view of what is reasonable, because I suppose the fear is that otherwise it's just going to be what Revenue Scotland decide is reasonable. So, I mean, does it actually work in England, and how does the actual advisory panel work in practice? Because I suppose that seems to be the essence of how you achieve objectivity.
I'll start and then hand over to Elspeth. I mean, let's be clear, the advisory panel hasn't formally pronounced in the UK GAR yet. We haven't had any cases before it, as far as I know. But in principle, what it is trying to do is to make sure, you know, as I think you put it very well, Mr. Chisholm, that, you know, reasonable is judged reasonably, to just keep peddling that word. It's not just HM Revenue and Customs or Revenue Scotland's view. It's the view of a reasonable group of people, and the aim of the advisory panel is that you're bringing in commercial common sense to that, and not to sort of override the rights of Revenue Scotland or HM Revenue and Customs to run the tax system properly and to police the sort of avoidance that Mr. Gibson was alluding to, but just to make sure that it's fitting in with what is happening in commercial reality. But Elspeth, do you want to carry on?
Yeah, I think there's one point where I think the advisory panel has been active, although they haven't heard and judged, as John says. They also had a role in reviewing the guidance that was being issued on the operation of what is the General Anti-Abuse Rule at the UK level. Guidance that I think was universally welcomed by practitioners, because it gave both a very succinct description of what the rule was trying to do, that it was game-changing, to use that expression, but also it went into some very detailed worked examples of why the law would be considered to be applied in particular circumstances. And of course that's a law that applies to a whole range of taxes, not just the two currently devolved as we have in Scotland. So it had that objective level of review on that guidance, and that's the kind of guidance that we would certainly support going forward, because it's not just this works or that doesn't. It explains why, in the context of the legislation and legislative principles, something is acceptable or is not acceptable within those provisions. So that was its additional role.
Now, I was going to ask about the guidance, because that seems to be another concern there, that you know, Revenue Scotland could issue. Well, the courts must take into account non-statutory guidance, and I suppose again, you've suggested one way of dealing with that in terms of some oversight of that guidance. But is there any other way of getting around that, or I mean, is it accepted that this level of guidance is required, or is there some other way of getting some? Or should some of that guidance actually be in legislation of one form or another, or is there any other way of ensuring that there's some check on the guidance?
I think the question to be answered with respect to this rule as it's drafted at the Scottish Parliament is actually what is going to make the guidance both workable to practitioners as well as succinct and clear in terms of Revenue Scotland fulfilling its obligations. I alluded earlier to the test about whether a transaction lacked commercial substance or otherwise, or was it artificial or otherwise. And it seems to me that having gone through the process of finding a model that seems to be, so far, working for the rest of the UK, and working partly because it's deterring people away from the kinds of behaviours that the tax authorities are wanting to steer people clear from, that it's one good model for going forward, and it should be seriously considered.
Can I just add briefly to that? I mean, it all comes back to almost where the convener started us. The guidance, in common with the GAR rule, should send clear signals that abusive tax avoidance is just not going to be tolerated, and it's not going to work. The point of an advisory panel looking at the guidance or something else is just to make sure it does contribute to making sure that that message goes out in a proper balanced way. What else could operate as well as an advisory panel? Well, it probably comes down as much as anything to our favourite topic of consultation, that even if you don't formally constitute an advisory panel, that guidance should go through bodies such as our own, so that we've got an opportunity to comment and just say, well, actually, yes, we can see what you're getting at, but it won't be read quite like that in practice, and it would be better if it was worded in this way to get over the message that you really want to communicate.
One of your concerns I wasn't quite so sure about was this issue about whether it should be one of the main purposes or the main purposes. I mean, I don't, on the face of it, see what the problem is with one of the main purposes, because it's still a main purpose, and I'm not quite sure why that's the fact there might be other purposes actually should make all that much difference.
I think our point was that we prefer the phraseology sole or main purpose being avoidance, so that really is the objective. But we can accept the way that it's been framed, but the risk of sounding like the proverbial record stuck in the groove, we just want to be sure that people going into normal commercial transactions are clear that they are, or presumably aren't, caught by this. Because I used the example of incorporation earlier. If I advise somebody on incorporation, one of the purposes of the advice will be to take into account tax considerations, because otherwise, I wouldn't be doing my job if I didn't explain that to you. So giving you advice on incorporation or not is immediately within the ambit, whereas if it was sole or main purpose, being avoidance, nobody would say that giving you advice on incorporation would be. So it's terminology. I think in many ways we accept that the one of the main purposes is where we are, and it's just trying to make sure that there's this proper balance to get to the certainty that we think is so important.
Thanks. If I can just ask you one final question really about another area. It's really just, I mean, different views seem to have been expressed over the last week or two just about the extent to which this bill is fit for purpose in terms of a greatly expanded range of tax powers, whether they come through enhanced devolution or independence. And I wonder to what extent you feel the bill is very much geared to the limited tax powers that are in the pipeline, or whether in fact it is essentially fit for purpose in terms of a wider range of tax powers.
My own view was that this bill does what I think it set out to do, which is to give everything it needs for the currently devolved taxes to be brought in to play, but it doesn't cover every possible circumstance for the future. It's covering in that the transaction taxes, landfill tax and land and buildings transaction tax are essentially one-off transaction taxes. If you were to look at, for example, income tax powers, they work on a whole annualised system of annual income on offsets of different things. So there's a number of powers that would probably then need to be introduced simply to deal with annualised taxes as opposed to transaction taxes. But I have to say, I don't think that's a failing. our concern way back at the start of this process was that you could try and devise a bill to deal with absolutely everything, distract attention. There will be quite enough to focus on in the bill as it currently stands, and far better to focus on a really good quality bill with one eye to the future rather than trying to cover everything at the same time, particularly when those tax powers hadn't been designed or determined.
I think I'm possibly a little more optimistic than Elspeth. I mean, I think this bill does a very good job in putting a framework for Revenue Scotland, because let's not forget it establishes that, a framework for powers that will apply in most circumstances, the tribunals. It's got a terrific amount in it, and I think, as I've said before, the bill team deserve great credit for what they have got into it. Does it take into account and cater for absolutely everything that could happen on devolution in any shape or independence? I don't think it does, and I don't think anybody could ever imagine it. I mean, you know, this week we're told, what was it, the reports in the paper today about a possible sugar tax. If the Parliament decided to introduce a sugar tax, would this cover a sugar tax? Well, I think the framework is there, but you'd almost want to be sure that it did. And as Elspeth alluded to, if Scotland takes over absolutely full powers for income tax, would you say that this would actually cover all that you'd want? Well, we'd want to test it, but as a framework that gets you most of the way, I think it's doing a very good job.
Then we're going to bring in the air tax, you know, the air you breathe tax, with the next rumour. Okay, John, to be followed by Jean.
Thank you, Convener, and I should probably declare the interest that I am a member of ICAS, which I think means I have to cross-examine them with more rigour. But anyway,
Careful of the disciplinary process, Mr. Mason.
yes, well, I might touch on that later, but we'll see how we get on. Yes, I mean, we have covered quite a wide range of areas, and I think I'd just like to go back over a few and question a few points that have been raised. So, I mean, maybe starting on the question of the legal profession as against the other professions. I mean, it seems to me I totally agree with the idea that there should be a level playing field. But I suppose the question is then, if we're in the position at the moment where the lawyers have a bit more privilege and accountants and tax advisors have a bit less, do we bring everybody else up and give them more privilege, or do we bring the lawyers down and give them less privilege and perhaps define it? And I would have to say the latter is the one I would prefer, but I'm not sure if you have particular views, if you feel it should be the more privilege for everybody.
I think the view we would take is that we're only looking at the powers in relation to certain information notices. So we're actually talking about the accountants, I suppose the accountants, the tax advisors coming up in a fairly contained area. And it's an area contained simply to support the open discussions when clients come in, and particularly when something's gone wrong. There's enough safeguards around what the advisors have to do in that. Absolutely everything else will, other than within tax advice, the area of tax advice, lawyers, I suspect, apply legal privilege to other things that really don't have a particular concern, but we're looking here very much at the tax piece. So it's a lifting up, but in a fairly defined and narrow area.
Yes, I mean, in your analogy, Mr. Mason, I think we would see, you start off like that, we would see the lawyers coming down and qualified tax advisors going up. Yes. So is it halfway? I don't know, but yes, it's a movement on both sides. Yes. And of course, some of our members are lawyers, the CIOT, and they do end up in slightly strange positions that
they're giving different advice. Okay,
yes.
Well, I think the bill team said they were looking at that. I mean, I was a little bit concerned. I mean, if somebody comes along and basically maybe they've just not done their tax return for a while, or whatever it is, and so their affairs are in a bit of a mess, and they're going to be open with their advisor about that, and then there seems to be an assumption that they shouldn't be open with Revenue Scotland about that. Now, I suppose I just wonder, you know, we've had a very confrontational approach sometimes between HMRC and taxpayers in the past. I mean, is it possible to have more of a kind of partnership approach that, you know, the advisor or the taxpayer goes to Revenue Scotland and says, OK, I've made a mess of it, here's all the information, you know, can we come to a reasonable agreement? Is it possible to have that approach?
Yes, It is. That's what I think we'd all promote,
Yes.
don't we?
That's an excellent road to go forward, and you'd hope that would always be your starting point. And I would be very supportive of the mediation facilities that are in the bill. Anything that helps get the thing fixed must be a good thing. I don't think privilege, though, is necessarily to cover up. I think it's to help get the best compliance ultimately. You know yourself, if you perhaps blotted your copybook, you're not quite sure how you might put it, and you might want to have a private discussion and then be assisted in getting it properly done. I would come back to the suggestion that our accountants are mainly fairly conservative profession, and they're there to help and there to make the system work.
Right, although we do have one or two accountants that haven't been quite so conservative. But,
Sorry, there's one further point, John, I wonder if I could make. The power we're looking at in the bill is only in relation to investigations. In the vast, vast majority of cases that you started describing, someone's not filled in their tax returns, going to their accountants. Of course, the expectation is that the full work would be done and full disclosure made to HMRC, all taxes paid and settled. There are cases, though, which is where I think this power was trying to get to, where a different view may be taken, say by the tax authority, and it's in a small percentage of cases. And there are experiences of HMRC taking a particularly aggressive view and wanting copies of absolutely everything, not necessarily at the right time for the disclosure to be made, or they may be making allegations or going beyond what is actually necessary for the full disclosure and settlement and regularisation of tax affairs to take place. So I wouldn't want everyone to think that it's a day-to-day occurrence for accountants to put their head in their hands and say, "Oh, I don't have privilege." It's really not a big percentage of cases, but where it applies, it's pretty relevant.
and presumably that's where the Charter might come in, that the attitude of Revenue Scotland could be in there somewhere, and also that they're equally rigorous with big taxpayers or small taxpayers, which sometimes in the past has not been the case. Okay. The word reasonable has been mentioned already, and you got some sympathy from Malcolm Chisholm, so I'll just give you a different view. We have this idea, and I still maintain my point that I think to use reasonable in the same sentence twice is bad English. I just wonder, really, I mean, we could just keep adding the word reasonable. I mean, I came up with a sentence with the word reasonable in 3 times. Because actually, even with the concept that's being suggested, which is along the lines of the arrangement cannot reasonably be regarded as a reasonable course of action, it still doesn't actually say who is going to have the regard. So, I mean, I would then add on a reasonable person cannot reasonably regard as a reasonable course of action. So that would give us it 3 times, which presumably would be even better. But, I do wonder, going down this route, and the phrase, I can't remember now exactly who used it, commercial common sense, to try and bring in commercial common sense, but that worries me, because does that mean we're swinging the balance towards commercial interests, the taxpayer, as against the beneficiary of the tax, i.e. the citizen? Any thoughts?
I think yes, I mean, the concern with reasonable is, as you're alluding to, Mr Mason, is who's reasonable and whose judgment. And if you want a 4th reasonable, you could add at a reasonable time of day to your examples. And, I make the point slightly facetiously but seriously because, let's face it, we would all come to slightly different views of what's reasonable at different times, different circumstances and whatever. I don't think, in all honesty, that one can get away from the use of reasonable. It is a well-used term. It comes up in cases. I mean, one of the prime uses is back to penalties and whether a taxpayer has a reasonable excuse. So it comes up a great deal. The concern is that it is a rather flexible term. It can change in the circumstances. And we're probably back to the need to establish some guidance, some track record of how this term will be used. And therefore, if it can be constrained rather than expanded in terms of the numbers of occasions it is used, it just contributes to the certainty. Yes, for the taxpayer, the business taxpayer or the individual, but it also translates through then there's a little more certainty in terms of how much tax will be raised by this revenue authority, by the power, and therefore the recipient knows a little more surely when they are going to see the money.
But I mean, would you accept that, I mean, as the convener pointed out earlier, the more we kind of pin these things down, the more we move away from principles back into what we're trying to escape from is very, very detailed rules and regulations?
I would go, as I said earlier, I quite accept the dangers of going down endless details, but of course it's striking a balance between those endless details that I don't think any of us want to go towards, and the legendary one section act that sometimes people say that the UK tax code could be reduced to, which is basically that the taxpayer shall be left with such proportion of his, her or its income as HM Revenue and Customs in their infinite discretion shall reasonably decide. And I should at that point say that I am a non-executive director of HM Revenue and Customs, and I don't support that. No,
well, probably most of us don't. I mean, on the point of kind of what the word reasonable means, I mean, if I'm understanding this correctly, the double reasonable test in England has not been tested yet, really, in court. And so, I mean, any words we use, and certainly the word reasonable, although it's been used in courts in other areas, it's going to be new ground we're moving into anyway, really. And presumably, therefore, if Revenue Scotland were to try and abuse their position and be unreasonable, that would soon be challenged in court, wouldn't it?
Essentially, yes.
Yes.
And I'm sure Revenue Scotland don't plan to set out to be unreasonable, but and it's without trying to do Charlotte out of a job, we don't want endless cases coming up to the tribunal. So it's giving some reasonable guidance. But Elspeth, do you want to comment?
I mean, I think I completely understand the slight frustration about the use of the word reasonable. I have failed to come up with a different one. So I suppose can't criticise on that perspective, but I think context is the way in which you apply what is reasonable, and context is what we're looking for to be given by a guidance, a separate panel, some moves towards objectivity rather than subjectivity and uncertainty.
Okay. Earlier on, I think it was yourself, Ms Orchardson, said that you reckon that most taxpayers want to comply. And in your evidence, if I can find it, only if they see that others are doing so, the convener said. In your evidence, yes, you say we should, or Revenue Scotland should treat the taxpayer as honest, brackets, unless there's good reason not to. I mean, I suppose I start with a slightly more sceptical approach in that there are a lot of people out there, really, what they want to do, first of all, is to pay as little tax as they possibly can, especially if they're writing a cheque for it, and self-employed people have more freedom than employed people, I guess. Do you stand by your claim that everybody's honest, to start with?
I think there's two different things apply. I think, and my experience is most people I've come across want to comply, and that means act within the law and act in a lawful fashion. But that can sit alongside not wanting to pay the maximum amount of tax possible, but the minimum amount of tax possible within the law. There are statistics on what is the scale of the black economy, which is those operating out with the law and not complying with their obligations. I'm not sure anyone's ever measured it accurately, but I think it's still expected to be a minority rather than a majority of the UK population. You get to the interesting question of how far is actually fairness a spectrum. If you ask a room full of people who would like to pay less tax, you get most people putting their hands up. Who would like, if they were given two legal alternatives, who would like to take the alternative that paid less tax rather than more tax? You would get most people saying, I want to pay less tax rather than more, but in that framework of complying and doing it legally. And I don't think you will ever get away from that, and I don't think we should necessarily try and get away from that. But what we try and do is make sure that the boundaries as to what's legal and what's not are as clear as possible and are as certain as possible. So you can then go back to people and say, no, you definitely were on the wrong side, or you were definitely on the right side. The wording we put in here was to stimulate debate. I think quite a few pieces come from some of the other charters around the place. John has alluded to some of the others internationally, but it's to try and get some flavour as to what are Parliament's thoughts around what should be in the charter. Are these reasonable comments? There's that word again. Sorry. Are these appropriate comments to make, or appropriate expectations, or not? Because I think if Parliament can set the tone and direction, it is a lot easier then for the professional bodies, ourselves and our members, to understand what you're aiming at, and also it's the direction you're giving Revenue Scotland.
Can I just add a quick comment briefly? I'd put it in terms of the vast majority of people in this country want to pay their taxes and move on. They've got better things to do than worry about. They want to pass on, and therefore they want to comply. And also, to get this into context, the UK generally, we are a pretty compliant country. 93.5% of our taxes just come in. HMRC gathers a little more on top of that. That means our tax gap is famously about 7% compared to about 13% in the US, 8 and 9% in Germany. You know, we are a pretty compliant nation. So, although I'm not in any sense saying we haven't got a problem, let's just keep it in proportion.
That's a fair comment. I just sometimes wonder how they measure these figures, but anyway. And the last area I really want to touch on, I mean, the suggestion, I think, again from yourself, Ms Orchiston, that if there was more certainty in England and less in Scotland, businesses would move there. And I'm just wondering, I mean, that would be, I suppose, a bit dependent on the type of business, because if you take somebody like Tesco's or Starbucks, they just want to be everywhere and kind of extract money from the population wherever they are. So if the tax situation from their point of view is slightly less favourable in Scotland or Holland or anywhere for that matter, that's not going to stop them going there and just concentrating in England, presumably. It just means that they would have to deal with that. Whereas the situation for another business, say Barclays, were thinking, are they staying in England or are they going to move to Scotland, then the comparison does become more relevant. Is that the case?
I mean, the discussion that took place in our office was really in the context of land buildings transaction tax, because it's the imminent one facing us, and locational decisions from those who might be investing in a portfolio and making that decision. It's not the absolute cost of the tax, it's the uncertainty as to whether the tax applies or not. Because if you know something is definitely going to cost you X, you will price that into your commercial decision on your deal. You might pay less for a piece of land because you've got more tax to pay. It's what the impact is of the uncertainty of, am I having tax, am I not having tax? And then probably, whilst that period of uncertainty exists, thinking, I can't be bothered with this, I'll just concentrate elsewhere. So that was the context in which that particular discussion took place. This was more about dealing with the uncertainty rather than the absolute cost.
I mean, from my own experience as a long-time tax practitioner, if you're looking at a location decision as to where does a business, or indeed these days where does a wealthy individual base themselves, tax is one of the issues, but it's only one of the issues. There's plenty of things. It can tip the balance. It's rarely, except frankly where people are trying to out and out evade, going to be the deciding factor. And obviously the evasion, it's, you know, we're off into a completely different area.
Yeah, because, I mean, it obviously is a factor, and some people go to the Isle of Man, the Channel Islands, because it's certain and they're going to pay less tax, but presumably, well, obviously not everybody goes to the Channel Islands or the Isle of Man, so...
Indeed. I mean, if, you know, I come back to, if you want to locate something, and as there was a period when I was looking at location studies and helping businesses decide where to invest, and tax, as I say, was one of the factors, but so was communications infrastructure, transport infrastructure, language, time zone, etc., availability of grants. You know, you can tick them off as well as I can, and all of those are put into the mix and they're all weighed up, and yes, tax is a factor. And very often, tax can be something, and particularly headline rates of tax, are what gets you to, as it were, the short list for the individual, for the company to consider. There's then more detail done, and at the end of the day, we'll see what the likely results are. And if the results are that we don't know how much tax we're going to pay in a country, or we're going to be subject to vagaries of a rapidly changing tax system, that will tend to put an investor off that country. But it is a range of factors.
Okay, thanks so much.
I don't know how rapidly changing many tax systems are, but I think there's a real issue about organisations. You know, Starbucks has been mentioned, and it was about paying the tax in the country where they make it, as opposed to looking at a country where they can, you know, whether it's Ireland, Luxembourg, or wherever, where they choose to pay the lowest tax for their entire European or worldwide operations. I think that's a separate issue from the one that John
It is, and of course,
raised.
as I'm sure you're aware, Convener, you know, it's something the OECD are seriously worried about with BEPS. But you say, in terms of how frequently, I'm aware that Brazil, for example, is legendarily the country where it takes longest to do your tax, and that is because basically the tax system changes every day. Very productive parliament, but not one I suggest you emulate.
Can you keep some of your Brazilian colleagues in work, though?
Indeed.
Jean, to be followed by Gavin.
Thanks, Convener. Actually, a couple of my questions have been answered. One of them was about the bill being fit for purpose given constitutional change in the country. But just following on a bit from the heartening information that most people are paying their tax, and while people want to know that they're being fairly taxed, or that they're paying their due, does that not reflect back on your earlier concern about the primary legislation that currently is about the tax to be paid, and moving and putting secondary legislation into the kind of default positions, or the tax evasion avoidance, or the penalty clauses being spelt out? But it would seem to me that if it's a positive bill, and if we're agreed that most people want to be fair and be treated fairly, that the bill would reflect that in primary legislation.
I think the view we took and our members are expressing to us is that this is a fairly historical bill. This is the first time this has come in the Scottish Parliament. And there are a lot of aspirations and expectations amongst our members that it should be as comprehensive as possible and set out a coherent picture. So this is what's expected of you, and this is what happens if you don't comply, which is where the penalties at the same level of detail as the obligations was coming in. It does need to do all these things, as you said. It needs to raise revenue. It needs to, or it should raise revenue. It should give certainty. It should see what happens to those who don't comply, who fall foul of it very clearly, and it should be fit for purpose. So I think everything sits together in the same place.
Yes, because if you know, why do 93% or whatever pay? Partly it's just the sheer confidence in the system. It's well run, it's by HMRC, it's well run by Parliament, it is not subject to whim, Brazilian style of constant change. It creates that confidence in the system, and that is an important message, I think, that the Parliament needs to send.
And just another question about, and I can't refer to it here, the page, but about the reporting to Parliament and how you envisage that being, and who should do that. I mean, you have some concerns, I think, in relation to.
I think from the face of the bill, we were slightly unsure exactly what the reporting structures were, and I know the bill says that a report will be laid, but there was no provision for accounts for actively reporting to Parliament. And I know we've had subsequent discussions since with the bill team explaining the finer nuances of how the board, the chief executive will report to the board, and the board is an office holder. But we just wondered if it needed slightly more clarity on the face of the bill or in supporting material so that people knew exactly how it was seen to be conducting its business.
Good morning. Schedule 1 of the bill says the person employed as Chief Executive may not be a member of Revenue Scotland. Are there advantages or disadvantages to that approach?
I'll, if I may, just reiterate something I mentioned in passing earlier. I am a non-executive director of HM Revenue and Customs, as it were, in my spare time, so I've obviously some experience of this. CIOT thinks that it is much better to have the chief executive and potentially chief operating officer, so in the words, senior members, the executive, if you like, of Revenue Scotland as part of the governing body in the terminology of Schedule 1 members. Why do we say that? It's to build the right sort of team basis of non-executives, if I can use that term, and executives, so that there is good interaction and good regular interaction. It seems a little strange to us if you are setting up a structure that has the members, all non-executives, governing, and when they meet, they don't routinely have the chief executive there. All right, they can call her or him in to see them, probably would as a matter of routine, but we just think it builds a better operating atmosphere, more regular operating atmosphere, if the top team, if I can use that term, consists of the members, the non-executives, and the senior executives. And as I say, from my own observation of being a board member at HMRC, that does work. We are trying to have a regular team approach of people who know and trust and deal with each other regularly. But that does not stop us challenging.
Does ICAS have a view on that one?
Yes, ICAS feels quite strongly that it would be much better as a mixed team of executives and non-executives. For the reasons that John has discussed, I think it's slightly disjointed to have a completely non-executive board. Revenue Scotland are going to be primarily operational, and to have a proper handle on how the operations are running, I think you need the Chief Executive on the board or part of Revenue Scotland as a member of Revenue Scotland. I just think it would all pull together much better if you have that mixture of executive and non-executive. I think that's what you do in most businesses. I think a complete panel of non-executives are perhaps at one remove. Quite often, it doesn't seem to make sense. I also perhaps might mention that certainly in the consultations, when we were asked about this before the drafting of the bill, I think the majority said that it should be a mixed board, so it seems quite unusual now. And certainly, it's my understanding in subsequent conversations that it's been decided to do it this way due to reporting, but I think that's perhaps slightly artificial.
Thank you. Move away from that then on to the issue's been touched on, but I want to explore it a little further. The issue of penalties, which I guess are primarily sections 148 to 185 of the bill. I don't propose to go through each section, obviously, but the point has been made, I think, by some stakeholders that the sections on penalties are perhaps a little light and over-reliant on regulations. As I see it, the section on failure to submit a return, to pay tax on time, to have an error, or if there's an under-assessment by Revenue Scotland, to have almost nothing in terms of specifics. Yet the sections 163 talks about not complying with an investigation. That has quite explicitly the penalty is £300, and if you then submit documents that have errors, it's £3,000. So some sections have literally nothing, others have exact sums. I just wonder what's your organisation's view on what needs to change to the bill in order to comply with the principles that you think are important?
I think that's very good analysis, and I think what we would see is needed is, for example, Section 150 to actually set out when what is a failure and essentially what the penalty is. And given that there is provision elsewhere in the Act for penalty amounts to be raised by secondary legislation to keep up with inflation or whatever, it's not going to hamstring the system if it's laid down in the Act to actually just spell out what are the circumstances, what are the amounts. And to me, it's as simple as that.
Yeah, I would completely agree with that. I mean, if we look at 150 and 151, they're probably the ones that need the most expansion. And I think your circumstances of when a penalty is payable should be on the face of the bill. The amounts should be on the face of the bill. Really, to me, the only thing that should be in regulations is more the procedure and the administrative side of it. Everything else should be in here, particularly on the most humdrum ones, which are the failure to make a return or failure to pay tax. They're the ones you come across most frequently.
Those are the regular ones.
Yeah, they're the regular ones, and the ones that really upset people when they get them, because usually they don't appreciate that they should have done it, so they think it's singularly unfair when they get it.
Okay. Just on one other area of penalty then, some of those are similar to each other, and so I won't press those points. Section 163 is under-assessment by Revenue Scotland. In a sort of brief reading of that, it seems to me that if Revenue Scotland make an error and under-assess, if the taxpayer, or P is described, the person is described in the bill, doesn't notice this through carelessness, they then have to pay a penalty, because Revenue Scotland have made a mistake. But it's up to Revenue Scotland to decide whether or not that person has been careless. It just struck me as giving Revenue Scotland a fair bit of power, and they could rectify their own mistakes effectively. I just wonder if there are views on that section in particular, section 163.
Yes, I mean we fully. Mistakes happen. Let's start with that. And in a sense, the starting point should be if it's an honest mistake on either side, people should not suffer. But what 163 is trying to get at, and I think you pick up on it very well, is the situation where it's blindingly obvious that the tax authority has made a mistake. I mean, to talk in income tax terms, where you've got £1 million income and they've put the decimal point in the wrong place and assessed you on £1,000, and you know perfectly well that that is screamingly obviously wrong, and frankly you should own up and say. And it's that sort of thing that we would accept if somebody does not own up. There's the possibility of a penalty, but even there you've got some issues around as to whether it really is that obvious to an ordinary taxpayer that this has gone wrong. And I think you put it well. 163 does seem to leave quite a lot of discretion to Revenue Scotland.
Yes, I was just going to say my handwritten note on this was that was very harsh because of that. Or two things. One is that in what will be quite an unusual situation, which in a self-assessment system, that you've gone through the process whereby you're still getting Revenue Scotland issuing an assessment and they make a mistake in it. I mean, that's going to be a tiny fraction of the Revenue Scotland business is going to be in that activity, and there's a really harsh penalty applied to it. Yet the bill is silent. To go back to your first point, your bill is silent on what are all the other processes and procedures that might take place on a day-to-day basis of who's doing what that might give rise to a penalty that then could give rise to something that's equally harsh. Could it be harsher? Could it be less harsh? Could it be we just don't know. But the tone of whether the penalty provisions in this bill should be really harsh, is that the tone the Parliament is wanting to set? Are they wanting something that's much fairer? There's another word we've used earlier today. Or something that's really quite lenient in certain circumstances, and then if there's persistent offences, shall we say, that something very, very penal is put into place. So that's what we were trying to get at, but the shape and consistency of the bill and the penalty system. What is it you're actually trying to penalise, and by how much, and with what caveats? That to our mind, to our view, the ICAS view, is that is for Parliament to determine, and that's why we wanted a primary legislation discussion around it.
Okay. Just to paraphrase then, is the view of your organisations, if you take the £1 million example then, if it is blindingly obvious to anyone, to use your term, that there's been an error made, in that scenario you would have a lot less sympathy with somebody who doesn't do anything. But if there's a small margin of error and it's perfectly feasible that you know, the error wasn't picked up, in that scenario it seems a bit harsh to penalise.
It's not just a function of size. It is obviously, we're in a complex area, so you have to have regard to, to use a well-known term, is it reasonable that the taxpayer could be expected to pick that up? So if you're dealing with the average taxpayer, and let's face it, most people, if they get a letter now from HMRC, do tend to accept that they've got it right because they don't understand life, its taxes complex, etc. So you project forward that something comes from Revenue Scotland and they say, we've assessed this, we've worked it out and the figure is so much, and the taxpayer looks at it and says, oh well, I suppose that must be roughly about right, and accept. You know, is that a reasonable thing? I come back to it. If it is blindingly obvious that that is completely wrong, then you can say the taxpayer's at fault. But whatever penalty is there shouldn't penalise the tiny error, or where it's just not something that you could expect the taxpayer to pick up. He or she is not the expert.
Well, thank you. Thanks, Gavin.
Okay, thank you very much, Gavin. That's concluded questions from the committee. I'm just wondering if there's any third points that you feel haven't come out in the questioning that you would like to make to the committee at this stage.
I think we've been given a good range, a good opportunity, Convener. Thank you very much for listening to us. And just to echo what we said earlier, we think the Bill team have done a good job. And this is a bill that I think we, as a body, put out a note earlier in the week saying we certainly award it 8 out of 10. And, you know, it will very quickly get to 9 out of 10 with the discussions we've said. And I don't suppose we'd ever say a bill was 10 out of 10.
I'm sure the Bill team will take 8 out of 10 at this stage. We're still going through all the stage 2 amendments, etc., obviously, and I'll produce our own report. But thank you very much, actually, for your comprehensive answers. Very much appreciated by the committee. I will now call a 5-minute suspension in order the witnesses to be changed and to give members a natural break. Folks, let's get back in business here. The second item on the agenda today relates to the UK budget, which is expected to be announced on 19th of March. I'd like to therefore give a warm welcome once again to Paul Johnson, Director of the Institute of Fiscal Studies, to our meeting, and invite him to make a short opening statement before we begin questions. Paul.
What shall I say by introduction? I think the key, I think the key messages with respect to the budget are the state of the public finances as ever. We finally got some relatively good news in the autumn statement. The OBR increased its view of growth last year and this year, and so borrowing this year is likely to come in knocking on for £10 billion less than last year, but still at over 110 billion. It's still a very large number. Where the Chancellor announced in the autumn statement that he will be adding an additional year to the years of spending restraint. So he announced that, assuming he is still Chancellor in 2019, he will be holding spending down for an additional year with the aim of getting a budget balance, or indeed a very small surplus, by then. That's obviously subject to immense amounts of uncertainty depending on what actually happens to tax revenues, what actually happens to growth and so on. But the one bit of good news that the OBR didn't come up with was a view that they didn't take the view that the potential of the economy had increased relative to what they thought a year ago. So actually the scale of the required fiscal adjustment, in their view, hadn't changed despite the additional growth we got last year. Their view that growth was essentially cyclical. It had come a bit earlier than it otherwise would have come. It wasn't additional growth. There's a lot of uncertainty about that, though, and one of the things we bring out in the Green Budget is there are some people, some macroeconomic forecasters, who believe there is a significant output gap, that the potential of the economy to grow is much larger than the OBR believes. If they're right, then actually the scale of the consolidation is more than will prove necessary. There are others who are less optimistic than the OBR. I think it's a very, it's a terribly difficult judgment to take. In terms of what can we expect in the budget in a couple of weeks' time? I don't expect anything significant which will change the government's expected fiscal path. So I don't think there will be a significant change to expected spending or tax in toto. So if there are changes, and I'm sure there will be, they will be offsetting. So there may be some additional spending reductions this year and next. I mean, that's the kind of thing that's been announced in previous budgets to make space for some tax cuts, or there may be some tax cuts paid for by some tax increases elsewhere. I'd be very surprised if there is a net giveaway or a net takeaway in the budget. Indeed, there has not been that in the last, since 2010. Each budget and autumn statement since then, for the period of this Parliament at least, has essentially been neutral. But that hasn't stopped quite a lot of activity within that, with quite a lot of work being put into, for example, fund substantial increases in the personal allowance, cuts in the rate of corporation tax and so on, which have required changes elsewhere. In terms of particular issues, we've looked in the Green Budget at what's happening to household incomes, and I'm very happy to talk further about that. And we've looked at some specific areas of tax and spending, which I'm also happy to talk about in more detail if members would be interested.
Okay. Well, thank you very much for that introduction. Obviously, Green Budget published on the 5th of February covered UK issues. There's obviously aspects of it which are particular to England, such as housing, childcare, etc., education. So I'll concentrate obviously on the UK and Scottish aspects. And you talked initially about public finances. The Long Road Ahead, I think, was the title for chapter 1, and I think it's been a long road already. So it's obviously going to remain long, and you talked about borrowing this year is forecast to be 111 billion, which is still 51 billion higher than forecast back in 2010. But you do talk about a forecast in the budget for 2018-19, but you go on to say that public sector net debt by then will still be nearly 1.6 trillion, or 76% of anticipated national income. And you go on to talk about substantial annual debt interest payments. I mean, obviously interest payments can change, but what is the current kind of level of interest payments that the UK is actually paying on this debt?
Well, we're on a path for the numbers are in here somewhere. I think interest payments are moving from I can't remember 20 to 40 billion or so over the period. I don't have that number in my head, but it is here. I mean, one of the reasons that spending on certain elements of public services are being squeezed so much is that debt interest payments are rising over the period. So if you look at the period between 2010 and 2018, total public spending isn't actually falling very much at all, but debt interest spending is increasing by more than 50% over that period, as you would expect. Some other elements of spending are rising, and to keep the total level flat, public service spending is being cut really quite substantially. So that role of debt interest, and I'm sorry I don't have the numbers immediately to hand, I mean, I can spend a couple of minutes finding them in the document if you'd like. That role of debt interest is an important one in constraining other elements of spending.
It's obviously likely to continue, as you said, for a number of years and get worse. Now, in terms of the risks on tax, bigger risks on spending, you talk about there being the remaining significant risks to both receipts and spending. I'm just wondering if you can expand on that a wee bit.
So on the, I mean, obviously the fiscal numbers depend overwhelmingly on what happens to growth. So, if growth doesn't turn out as expected, then tax revenues in particular will turn out very differently. So the reason that we have such a big deficit now compared with what the government was hoping back in 2010 is that growth hasn't arrived, and therefore tax revenues are very much lower. So there's obviously a growth issue. If we get the growth as expected, then the expectations of tax receipts look to us reasonable, with three, I think, concerns. One concern is that the forecasts for tax revenues include default indexation of things like petrol duties, council tax, business rates, and those sorts of things. Well, this government has, and indeed the previous government, has not managed to increase petrol duties in line with inflation for a very long time now. Council tax has been frozen in England for, I think, 3 years, and in Scotland for quite a lot longer than that. And there's quite a lot of changes going on in the field of business rates and so on. So there are policy risks here. So if it continues to be the case that we can't increase petrol duties for whatever reason, then revenues will need to be made up from elsewhere, or there'll be a bigger gap. So that's one of the risks. There's policy risk. A second potential risk is the increasing dependence on capital taxes, by which I mean stamp duty, capital gains tax and inheritance tax, which are forecast to make up 5% of all revenues by 2018. Now, that will be the highest level they've ever reached, and particularly for things like capital gains tax, there's a great deal of uncertainty about whether, how that tax will move going forward. And then the third area of risk, I mean, I should say there are upside as well as downside risks on these things. The third area of risk that we, on the tax side, that we bring attention to is the extent to which we have become increasingly dependent over quite a long period on a very small number of taxpayers for a very large proportion of total revenue. So, for example, the top 1% of income taxpayers pay somewhere between 25 and 30% of all income tax, which itself is about 8% of all tax. So, and that's just the income tax that they pay. And the top 0.1% are paying more than 10% of all income tax. So that's 30,000 individuals paying more than 10% of the entire income tax revenue. Now, that's, of course, because these guys have such an enormous amount of money. But when you are that dependent on that small a number of individuals, changes in their behaviour has the potential to make your tax revenues somewhat volatile. So I don't think I think our view is that the government estimates are probably the best central case. I mean, they are a sensible central case, but there are some risks around them. I think probably of all of the three that I've mentioned, I think the policy risk may be the biggest, actually, because there are policies. It has proved difficult to achieve some of the policies that are assumed. So that's on the tax side. And then on the spending side, I think the risk really is associated with the scale of the cuts which are anticipated. Now, we have had some fairly significant cuts in public service spending in police and transport and defence and local government and so on already. Those cuts have actually proved in some senses easier to deliver than perhaps some was expected 3 or 4 years ago. They have been delivered, and indeed they've been over-delivered. Departments have spent less than their budgets up till now. But actually the cuts, we're only a third of the way through in that public service spending area, a third of the way through the cuts that are now planned up to 2019. And that will mean, if they continue to move in that direction, and if health and so on continues to be protected, cuts of more than a third between 2010 and 2018 in those budgets. Now, that's a very, very large cut to achieve, and it will take public service spending to its lowest level since we have comparable data back in the late 1940s as a proportion of national income. Now, whether that is deliverable remains to be seen. As I've said, it has proved perhaps more deliverable than was expected so far, so that may continue to be the case. On the other hand, presumably the easier cuts have already been made, and it's harder cuts which are still to come. Then finally, I would add two particular sort of things which may make this even more difficult than it appears. One is that the current government has already promised significant additional spending increases for the next Parliament, which are unfunded in a sense. So there are 7 billion of promises for additional spending, which will mean 7 billion of cuts from the rest of spending. And secondly, the population is growing and ageing really quite rapidly over this period. So the spending per head is falling more quickly than total spending. So we're going through a period of remarkably rapid demographic change over this decade, and that will make some of these things, again, harder to achieve.
Comments, a lot of food for thought from members of the committee, so I'll take on a couple of these issues, and then I'll want to open things out to members of the committee who are all lining up with questions already. First thing, in terms of freezing fuel duties through to 2018-19, which you touched on, you said that would cost £4.2 billion, but surely one of the reasons that the government would suggest for not increasing fuel duties is because it's relatively high relative to other countries, and that undermines competitiveness, and also there's an issue about the impact on household budgets. So although it might be £4.2 billion on the face of it from revenue, there's a counter argument that if businesses can't compete because of high fuel duties relative to competition elsewhere, then they're not in a position to pay some of these taxes. So surely the 4.2 billion is a kind of two-dimensional figure, really, and doesn't take into the impact in the round.
Sure, the actual net cost may be a little bit less than that because of some of the behavioural effects that you're describing. I mean, the point we were really making is that the official forecasts for revenues assume that fuel duties will rise and that we will get that additional 4 billion of revenue. We're really asking the question, is that actually going to happen? I don't know, but history suggests that it might not. The first round effect of that will be that revenues will be 4 billion less than they otherwise would have been. It may be that this has some behavioural effect on economic activity which will raise other revenues. There is no prospect that it would raise it by anything like the 4 billion. So the real answer might be 3.5 billion rather than 4 billion or something. But I think the point stands, which is that it will require a change of political direction, in a sense, to secure those revenues. Now, perfectly sensible to choose not to increase those revenues and to decide to raise revenues elsewhere, but that is a choice that would have to be made if you wanted to keep the same total level of revenue.
Sure. Now, you say, and you've alluded to it, you say if protection for schools, NHS and aid spending were continued through to 2018-19, other unprotected departments would be facing average cuts of 31.2%. And you go on to say that even if NHS spending, I take it in England, were protected in frozen real terms between 2011 10-11 and 18-19, real age adjusted per capita spending would be 9.1% lower. Now, obviously, the obvious question is, what will be the impact on Scotland's budget?
We haven't pushed these numbers through the Barnett spreadsheet. It would have whatever the Barnett consequential. The effect would be whatever the Barnett consequentials would be. So it would be, I would guess, similar proportionately to the to the cut in the overall UK budget. But that's not a number that I think we've calculated.
Right, OK, so you can give us some kind of ballpark, because you're saying even with the Chancellor's move to 12 billion of further cuts to social security benefits, implied cuts to public services for 2010-11 to 18-19 would mean departments facing budget cuts of 17.1% on average.
I don't have any reason for believing that those numbers would be significantly different in Scotland.
OK, thank you for that. And just before I open up, just one final thing, which is about the issue of spare capacity and productivity. You recall in previous discussions, we had quite an extensive discussion about productivity, and there was some kind of uncertainty, and this isn't just IFS, but also with our own previous economics advisory committee, about why productivity in relative terms hadn't really increased when one considers what's taken place in the last few years. I mean, one would have expected in normal recessions that the economy would shrink, but the number of people in the workforce would shrink further, so that there would be productivity gains, etc., and that hasn't really happened in this recession. So I'm just wondering if you can talk us through, just for a couple of minutes, the situation with regard to productivity, and also, which you have touched on in your paper, specifically the issue of spare capacity in the economy.
Well, I'll try, but I'm not going to provide any definitive answers, I'm afraid. So what's been happening to productivity over the last 5 years? It's dropped, and it's dropped remarkably fast, against a sort of normal trend when it would rise. So there's a big gap opened up in terms of productivity relative to what one might have what one might have expected. Now, why is that? Well, part of it is that this is the kind of flip side of what I think is the extremely good news story about what's happened over the last several years, which is employment levels are actually higher than they were pre-recession. Sort of arithmetically, employment levels are higher, output is lower, productivity has gone down. What's causing that? Well, there appears to be an increasing amount of evidence that some of this is associated with the type of recession that we've had. It was a financial crisis. Therefore, the funds available to business have been less. The banks have not been lending, and particularly not to new businesses. Old businesses seem to continue to be able to access funds, but new business and new projects are not being funded. So business investment has been at very low levels, and so the capital, as it were, that workers have to work with has been lower, and that's clearly played some role in this. And then there is this point about the numbers of people in work, and which is driving which is hard to know. Is it low productivity driving high demand for low skilled labour, or the other way around? But there does appear to have been a change in the way that the labour market works, which has allowed or perhaps pushed more people into work relative to, for example, the 1980s, when a lot of people lost touch with the labour market very quickly. Now, that's partly to do with the type of recession we've had. It's probably partly to do with the current structure of the welfare state, which has increased the sort of labour supply of some of these people. I think the big uncertainty going forward is, at what point does this productivity story start to take a turn upwards? I'm no doubt we'll be arguing for a long time about the causes of what's happened so far. The uncertainty, I think, is about when that starts to turn up. Now, it's at that point that you kind of get to the link between what's been happening to productivity and the question about the scale of the output gap. Now, if the lost productivity, the amount of loss, if a lot of the productivity we've lost so far is regained, if there is scope for that, then that is that would be equivalent to saying that there is a large output gap remaining. If it's not regained, then that's equivalent to saying there isn't much of an output gap remaining. Now, I think it's very hard to judge where that output gap lies. I think there is a why might you think there's very little output gap? Well, you might think there's very little in the way of output gap, partly because we have got very high levels of employment, and if you think the sort of equilibrium rate of employment is somewhere in the 5–6% range, well, we're not very far off that, so that means there's not an awful lot of space left in the labour market. And the fact that it may not be that business investment, whilst it may pick up, there's no particular reason to think it will pick up everything that is lost over the last 5 years. So that would be a story which said you've got a rather small output gap. A story which tells you you've got a rather large output gap would be one which says, well, there's a lot of people in work, but a lot of them are working part-time and they want to work longer, and that business investment may well make up a lot of the gap that they've lost over the last few years. I think the problem is that we won't actually know the answer to this question until, several years down the road, by which time choices will have been made about the scale of fiscal consolidation, which will be partly irreversible.
Has reduced labour costs actually had something to do with it? Because, we're also talking about a 6% reduction in real mean household incomes. So therefore it's been less expensive to retain labour than perhaps it's been in previous recessions.
Yes, and I think, again, the question is why. It certainly has been less expensive to retain labour. Real wages have fallen by 7 or 8% over this period, which again is historically unprecedented. I don't think we've seen a period like that. There were some times in the 1970s when inflation was very, very high that wages weren't keeping quite up. But certainly during a relatively low inflation period, we've never seen anything like this. So the question is, why have wages remained low? And this is where it's very difficult to get at the causation. It may be that productivity has been low and that's resulted in low wages. It may be that companies have got more power in the labour market, can pay low wages, and therefore the incentive to increase productivity or the large amount of labour has itself reduced levels of productivity. So which way round that is working, and there's probably a bit in each direction, I think is uncertain. But certainly, that very unusual labour market behaviour has certainly been at the root of what's been happening to output to employment and to household incomes.
Okay, thank you for that. So the first person round the table to ask questions will be Michael, to be followed by Jamie.
Thanks very much, Mr. Johnson, for the outline you've given us. In terms of the UK economic outlook as you see it, you're predicting growth at a higher rate than the OBR did, if I understand that right. When the OBR predicted their growth rates, a number of commentators said that, given that the trade and the economy is cyclical, that the levels at which the OBR were predicting growth, you could have predicted that anyway. There's nothing actually that the government are doing which is stimulating this increase in growth. It would have happened just as a matter of course. Your predictions are slightly higher than that, so is there something that the government's doing that you think is going to increase growth beyond what the OBR is saying, and how do you feel about the comments that this growth level at which we are told to expect is no more than we could expect in comparison to other economic indicators that would be at this point in the economic cycle?
So I should be clear that we ourselves are not making growth forecasts. There are some growth forecasts in here which Oxford Economics separately have made, and their view of, this relates to the previous question, their view of growth is actually not very different to that of the OBR over the next several years. Where they differ from the OBR is they think there's a significantly bigger output gap, and so they think that growth, while they haven't forecast the figures, they think that growth will be able to continue for quite a long time after 2018-19 at more than 2%, which the OBR doesn't believe. So it's that difference in the output gap rather than the growth over the next 3 or 4 years, which differentiates Oxford Economics rather than IFS from the OBR. I think the to what extent that is determined by government policy, I think is often, I take a slightly slightly the view that over short periods, over the next 2 or 3 years, how much difference can government make to that? Relatively little, unless it has a kind of big fiscal expansion. That then has trade-offs or costs down the line. In the long run, what government does can have a big effect on growth and productivity. So the way that the education system is structured, the amount of infrastructure that we have, the design of the tax system and so on. But changing those things now will impact on growth and productivity over the next decades rather than over the next 2 or 3 years.
Okay. Going on to another issue that you touched on about this, the productivity. There's different arguments, as you're well aware, about how valuable it is to have income thresholds increased, or the allowance thresholds, sorry, in terms of taxation increased, in order to prevent in-work benefit levels. But you appear to argue that raising the threshold to 12,500 is not as effective as it would be to actually maintain or increase tax credits for people in work. And that seems to go against the perception that it's better not to have people who are working in benefits.
Well, of course, I mean, as ever, there's a trade-off here, and I think what we, so that there are pros and cons. The issue with raising the issue with raising the personal allowance is first that it's extraordinarily expensive. This government has already spent more than £10 billion a year increasing the personal allowance, which in current fiscal circumstances is quite a large investment. So it costs you a lot of money. Raising it further will be less well targeted on the lowest paid, partly because, particularly among low-paid part-timers, quite a lot of them have been taken out of income tax already, and partly because you're now at the position where the personal allowance is close to the personal allowance for pensioners, and so you start to benefit pensioners as well, which you may want to achieve, but if what you want to do is help people on low pay, then that's clearly not targeted on them. So I think the issues, that said, in terms of changing the income tax system, that's the most progressive, increasing the personal allowance is the most progressive way that you can change the income tax system. I think the second point is that if you want to change the direct tax system in a way which helps low-paid individuals, it's quite clearly better to increase the national insurance contribution floor, the point at which you start to pay national insurance contributions. So that both captures more people because it's set at a lower level, and it's only focused on people in work. So I think if what you want to do is help low-paid workers through the tax system, it's really entirely clear that you want to raise the point at which you start to pay national insurance contributions rather than increase the point at which you start to pay income tax. The question then comes to what about in-work benefits? Well, then you do really have a genuine trade-off. If you've got a very limited amount of money, you can do an awful lot more with in-work benefits because you're targeting it very precisely on people with low household incomes. The downside, of course, is that once they're on in-work benefits, then the tax rate, the withdrawal rate they face can be very high indeed, 70–80%. So their incentive to work more is very much reduced. You may also have less than 100% levels of take-up. You may, for other reasons, not want people in work to be on benefits. So there is a trade-off here, and what we've not said, I think, is you should do one rather than the other. But what we have said is within the direct tax system, it's clearly NI rather than income tax you should be looking at. And if you and then you need to think very carefully about the trade-offs between changes of the tax system and changes of the benefit system, depending on exactly who you want to target and how worried in particular you are about some of these work incentive effects.
Also, you mentioned the figure of the increases in employment levels. But there's an increasing picture of underemployment within those statistics. So there might be individuals who are ostensibly employed, but are on 0-hour contracts or on part-time work. Therefore, the amount of productivity that they're achieving could be much less than you would expect had they been employed in full-time contracts and being paid at a level which incentivised them to actually work more and produce more. So we then get into the argument around whether incentivising people to work by increasing their salary would have an impact on the economy, and then that brings us to the living wage. Now, we had the scare stories about how adversely impacted the economy would be by the introduction of the national minimum wage, and we're now hearing those same concerns being raised in relation to introduction of the living wage. Is that something that would help increase productivity? What would be the adverse side of a living wage? And what would be some of the complexities of its introduction?
Yeah, I think that's another tough question. There is inevitably, there is inevitably a point at which a higher living or minimum wage has a negative effect. I mean, at an absurd level, you clearly couldn't introduce it at £20 an hour. So the question is, at what point between where it is at the moment and £20 an hour does it start to have that negative effect? Now, one thing we do know is that once you get up to the living wage kind of level, you're affecting a much larger chunk of the population than you are at the moment. So you're hitting somewhere around 20% of people in work at the living wage level, when the minimum wage, I think, is more like 5%. So you're getting to a much thicker bit of the earnings distribution. Now, that may have positive effects in the way that you describe, in the sense of forcing higher productivity, in a sense, or it may have negative effects because you're now impacting a lot more people, and employers may respond by having fewer jobs. Now, what the Low Pay Commission has tried to do essentially over the last decade and a half that it's been in place has been to try and make that judgment about at what point can you keep moving the minimum wage up such that it is not having, they can be quite confident it isn't having a significant negative effect on employment and the labour market. And they've made that judgment, and they increased it quite significantly initially, and then they've reduced it again. Probably, I expect it will start to increase a little bit over the next few years. Their best judgment is that it's where it is. To increase it to the living wage, I think their judgment is would have negative effects on employment. Certainly, if you did it straight away in one big chunk, moving it gradually in that direction may have a less deleterious effect. But this is it's a terribly fine judgment about where you think it starts to have that impact. I think what I repeat is what I said at the beginning. One thing we do know is it starts to impact an awful lot more jobs if you start to increase it significantly above where it is at the moment.
Okay, Jamie, to be followed by Malcolm.
Thank you, Convener. Looking at the summary of the Green Budget, I want to focus on some of the same areas that Michael has already touched on. I wanted to talk about the income tax personal allowance, but I think that's probably been usefully explored. But I thought it was interesting where in your summary you say that a substantial minority, 30% of those who are low paid, have partners who are not low paid. Hence, policies that help all low-paid individuals will also help some relatively high-income families. I suppose the first question that begets is, what are you defining as not low-paid? And it's an interesting question of emphasis, because what is defined as a substantial minority, the flip side is the overwhelming majority. 70% of those who are low-paid don't have partners who are whatever you have defined as not low-paid.
So we've defined low pay relative to the living wage in here. So
can I just clarify that? So anyone earning the living wage is not low paid?
That's the definition we've used in that chapter. You can clearly put that wherever you decide to put it, in a sense. So you're right. Clearly, most of the effect would be for that particular group. I think the point about I think I make 2 points about the personal allowance. As I say, if you're going to make changes to the income tax system, then increasing the personal allowance is clearly the most progressive thing that you can do. Secondly, when you're targeting things, whether it be wages or income tax or national insurance on individuals, some of those individuals will themselves have low income but you'll either have partners who are better off, or particularly when you're looking at the minimum wage, an awful lot of people on the minimum wage are relatively young people living at home with parents who, and therefore in a household that may not be terribly badly off. So it depends what you're concerned about. Are you concerned about the income of the individual, the income of the individual and their partner, or the income of the household in which they live? And those are, those in some sense are political rather than economic judgments. And the other thing about the personal allowance is clearly everyone, the natural effect of an increase in the personal allowance is that everyone who is an income taxpayer with incomes below £100,000 a year at least will gain. This government has, on a couple of occasions, ensured that higher rate income taxpayers don't gain, but on other occasions at least ensured they don't gain more than basic rate taxpayers. But inevitably, people who are not on low incomes gain as a result of this. And again, that's well, in a sense, that is a good thing. People get better off, but it's one of the reasons why it's so expensive. It's why an increase from £7,500 to £10,000 costs you £10 billion, because you're giving a bit of money to a lot of people.
In this definition of those who are not low paid, you would accept, though, that those earning the living wage, they may be defined as not low paid, but they're not exactly wealthy, are they?
No, of course.
Yeah. Just turn to the issue of the living wage. Further, you'll be aware the Scottish Government's committed to paying all its employees the living wage, and you talked about what stage where you start increasing the minimum wage. Does it have a negative effect? Maybe we're talking about you talk about the vast difference in terms of the minimum wage affecting 5% of the population, up to the living wage up to about 20% of the population. But just this whole narrative of having a negative effect on the economy, I mean, I'm right in recalling that this was the same set of arguments that were laid out when the minimum wage was introduced, aren't they?
Yeah, and I think the judgment of the Low Pay Commission has been that they're setting the minimum wage at a level where it's not creating that kind of damage. And I said, at some point, it clearly will do. And I don't know where that point is. It may be below or it may be above the living wage. The Low Pay Commission's view is that it's roughly at where the minimum wage is at present. I think this is, it's very difficult to know what the impact would be beforehand. But as I say, I think what I find the most kind of compelling piece of evidence is, or evidence, but something that you need to take very clear account of is moving from something that affects 5 or 6, 7% of the population to something which affects 20% of the population. You would expect that to have a different kind of effect.
Surely it could have a positive effect insofar as, again, these individuals aren't wealthy, they're not saving for a rainy day, they're spending the money they earn, so that could have a positive economic impact, couldn't it?
Of course. I mean, it would depend on the response to the pay. So if you introduce this minimum wage and the living wage and the only effect that had was to increase the incomes of people in work, then that would be positive. But that money has to come from somewhere. So that either comes from...
Couldn't it come from increased economic growth as a consequence of having changed the minimum wage?
Well, perhaps in the very long run, but certainly not in the short run. I mean, it's not going to have that effect in the short run. So it may come from some businesses who are just sitting on cash piles, but actually most people, or a lot of people affected by these low levels of wages, are working for rather small employers. Small employers tend to pay an awful lot less than big employers, so that it's probably not going to come from cash piles. It might come from lower wages for better off for those who are earning a bit more at the moment. It might come from higher prices. It might come from lower profits. I mean, it's got to come from one of those places, which is going to have some other effect on the economy, or it may come from fewer people in work. I mean, I don't know where the effect is, but there isn't a sort of, as it were, a cash machine which will create this money that people will get. It will have to come from somewhere else.
I mean, following this line of inquiry, and looking at the summary in relation to the Chapter 6, the squeezing incomes, you're clear that the average price level faced by households in the bottom quintile rose by 7.1% percentage points more than those faced by households in the top quintile between 2008 and 13-14. I mean, that's clearly got a, that's intuitively, I think, in terms of the evidence base, it's going to have a negative effect on those individuals, those households. For example, the Welfare Reform Committee here yesterday heard evidence from the Trussell Trust, who told us food banks that they operate in Scotland, there's 300% more people this year using them than last year. But again, presumably this could have a negative economic impact on the same point I've just made. These are households that aren't putting money aside, they're going out and they're spending it productively, and if their income is being squeezed, they can do that less than they could previously, whereas the top quintile, you know, they're more likely to be putting money away and saving for retirement or 2 or 3 holidays a year or whatever. So, you know, have you got any assessment of the negative economic impact?
Well, I think, you know, it's important to be. I mean, I think the big impact here is a negative social impact. So, you know, making people on very low incomes worse off is, you know, it has an immediate impact on their.
I think we accept that, and that's obviously readily understood.
But so so what's been happening here, of course, is this has been driven by increase in energy prices, increase in food prices. So that's why inflation there has been higher. And for better off people with mortgages, big falls in interest rates have made them relatively better off. So that's been what's driving it. I think you're right to an extent. If people with low levels of income are seeing their incomes fall, and you know they're a group who spend all of their income, then that's going to have an effect on the economy, perhaps more immediately and directly than if you're taking money away from people who would otherwise have saved it. So yes, I think they're, you know, taking money out of the economy, out of people's pockets, has a negative effect on growth in the short run.
Thank you. One final question, if I may. Conveners, just relates to, I suppose, a policy divergence between what's happening here in Scotland and what's happening south of the border. It relates to right to buy, which you talk about in Chapter 5, which is about housing market trends. And I thought it's interesting what you say. You clearly talk about the excess demand for public housing, and you say some localities. I'd be interested to know the localities. Maybe it's more to do with the localities I represent as opposed to others, but certainly in the localities I represent, there's none that don't have an excess demand for public housing. So you talk about that, and then at the end you talk about it's unclear whether the UK government's policy of further entrenching the right to buy, increasing the amount of discounts, it's unclear whether that policy will achieve the desired balance between increasing home ownership and minimising reductions in social housing. But I would have thought there'd be plenty of evidence given the pattern of housing tenure over the period of right to buy's existence. I mean, on the one hand, we have this government that's implementing this policy, and at the same time they've implemented a bedroom tax because they say, well, there's not enough houses to go around, we've got to get that public housing right, get the right people in the right houses, but at the same time they're selling off the housing stock. Surely the evidence base is there already.
Well, I suppose what we're trying to say, it depends on how you weight these objectives. If you weight increasing home ownership extremely highly, then this might be the kind of policy that you pursue. But I think you'd have to weight that very high relative to the demand for social housing. I think if you put any significant weight on the demand for social housing as a policy objective, then
they do. That's why they've introduced the bedroom tax.
Then so again, as with most of these things, there's a trade-off. I mean, increasing right to buy clearly implies a trade-off where a large part of the objective is increasing owner occupation relative to being clear that you've got enough social housing.
Consider this an effective use of the public housing stock?
As I say, I think that's a policy trade-off for politicians to decide on rather than something I'd want to pronounce on.
Okay, fair enough.
Malcolm to be followed by Jean.
You said that you didn't see any reason to think the 17.1% average reduction in at UK level wouldn't be replicated in Scotland, but I mean surely because of the protection of health and schools at UK that works relatively favourably for Scotland, given that they're about half the Scottish budget.
Yes, that would be that would be right for that part clearly, but the yeah, I say we haven't run this through, so I wouldn't like to say what the.
I just wanted to say that in
be.
case anybody runs out the room and says there's going to be a 17.1% reduction in public expenditure in Scotland. I mean, you dealt with the risk. It could be a whole lot worse. You dealt with policy risks and you know, dependence on capital taxes, dependence on the small number of taxpayers at the top, and so on and so on. But you didn't actually mention two of the things you mentioned in Chapter 4, which you said that the risks around our forecasts are more balanced, but the main uncertainties around the housing market and the high level of consumer indebtedness. So are you saying that they actually could make it a whole lot worse as well, or you think that's not likely to be the case?
Well, I mean, I think our view of the housing market at the moment is that it doesn't pose a very great risk. Prices are still well below, outside of very particular bits of central London. Prices are still well below where they were in 2007, and I think the most likely path is for a continued sort of improvement in the housing market. We're not anywhere near, in 99% of the country, bubble territory. So I think the prospects there are probably relatively positive. In terms of consumer spending and consumer indebtedness, one of the problems here is that ONS numbers are changing all of the time. So I think even since this, which we went to the printers about 6 weeks ago, the ONS have changed their view about how much of last year's growth was down to consumer spending as opposed to business investment, and moved it in a kind of positive direction. But again, I think the evidence is that we're not yet at a point where one will worry too much about about where we are with that. But if growth this year, for example, were to be fuelled by further, with little in the way of business investment and by significant further increase in consumer spending and indebtedness, then you would start to begin to worry about that.
So it's all pretty gloomy, except you do say the most optimistic assessment of the amount of spare capacity all spending cuts planned beyond next year could be reversed, but you're obviously not totally persuaded of that scenario. But I mean, you've touched on this to some extent, but are you basically saying that output gap is almost something that governments can't do much about? I mean, you seem to be saying that, but I mean, surely even the last two things you suggested were relevant: business investment and consumer spending power. I mean, to some extent, both of those can be influenced by government policy, can they not? Not to mention public policy, obviously.
Yes, so you can. I mean, clearly, policies like patent boxes and RED tax credits and corporation tax and a whole series of other policy subsidies impact on business investment. Probably the most important thing that's impacting on business investment, though, is availability of finance, and there are certainly some policies to impact on that. So there are policies that can affect that. I mean, I think most of these things are more. It's easy to affect in the long run than to make something happen dramatically tomorrow. And again, you can have, and where you can make things happen very quickly, you often have to pay a price later on, because it often involves a higher level of borrowing in the short run. Now, that may be a price worth paying, in the sense if you get a very high multiplier on your spending now relative to what you might in the future. But I suppose I'm slightly sceptical about the extent to which, in the short run, the government is able to manipulate these things.
Now, you've been asked a bit already about policy to help the low paid, which was all very interesting. There was just one bit I was slightly puzzled by, because I would have thought, one of the problems about the tax credits and so on has been the rate of withdrawal, and it seems that raising the amount you can earn would be a positive thing in terms of work incentives. But you say at the end of one of the sections that it would make 200,000 people more families eligible for universal credit, leading to weaker incentives for some people to earn more. I mean, but surely the higher disregard, I mean, that's a work incentive rather than a disincentive.
As with all of these benefits, there's a trade-off. So if you increase the point, so there'll be a benefit for those who are at the bottom of the system, as it were. So they'll be able to earn more before having anything withdrawn. But then that pushes the further up the distribution, the point at which you people are affected by universal credit and therefore reduces their work incentives. These trade-offs, you just can't get away from these trade-offs.
Well, presumably you could get around that to some extent by withdrawing it just more gradually, no? Would that not get
Well, you could,
yeah.
but if the more gradually you withdraw it, the more people you bring in.
Right. Okay.
So there is, you can have a trade-off, anything between a sort of a citizen's income, which you pay to everybody, and then everybody's facing a tax of whatever it would be, 60% to take it back. Or you can just pay income support with 100% withdrawal, which affects a much smaller number of people, but has a very negative effect on their work incentive. So you just can't get away from these trade-offs.
So finally, your section on childcare was really interesting. I mean, I suppose you were coming across here as a bit of a childcare sceptic. I mean, I think we would all agree it's good for child development. So I think it's quite right to distinguish between the child development effects and the employment effects. But I was kind of a bit surprised when you said that. I can't find the exact words, but you were implying there wasn't really very much evidence about employment effects. I mean, was that sort of internationally, or was that just in terms of the way it operates in England currently, if you see what I mean?
Yeah, I think, in a sense, we were a little surprised at the paucity of the evidence on this. And I think what we weren't trying to say here was spending on childcare is a bad thing, but what we were trying to say was there's a degree of conflation in the debate about what it's for. So you get the sense when some people speak as though they think spending on universal childcare is a good thing for helping children from very deprived backgrounds. Well, maybe a little bit of help, but that's not really what's going to help. It's much more targeted and high-cost interventions which involve significant childcare. And the second thing that one likes to hope from childcare is that it will improve labour supply. Now, there is a bit of international evidence that can be effective. There's very little UK evidence, and it's actually this isn't to say isn't effective, but there really is remarkably little evidence that it is effective in the way that it's delivered. And then the third thing I think we wanted to point out here was the current way in which we're spending the £7 billion or so, which we in the UK spend on childcare policies, is very fragmented and complex. So some of it's about direct delivery, some of it's about subsidy, and the way the subsidies work is itself very complex. So the amount you get depends on the exact number of hours that you're working and your exact income, which is obviously going to change over the year. And is likely to be a difficult way of making it all work. So yes, we're certainly sceptical about the current structure of spending on childcare. Almost certainly, if we were clearer about the objectives, clearer about the evidence of where things work, and clearer about how we were going to deliver it, we could spend this money in a more effective way.
Potentially, that could influence the output gap.
Yes, so I think if you do things which do, in the short run, increase labour supply, or in the long run increase the productive capacity of young people, then yes, you're going to influence. You could influence that.
The other European countries do have more. Some European countries have much more extensive support for childcare. I mean, so. Would it be difficult? I mean, I suppose it's part of the difficult in research to disentangle those effects from all the other things that are happening in the economy, because intuitively it would seem to be. That's why I was surprised by your statement, and I've obviously read quite a lot where it's presented as evidence that if you expand childcare, I mean, not just in terms of nursery education, but in terms of to cover working hours, then that does certainly increase. Most obviously, increases female employment rates.
I mean, I think there's 2 points. One is if you look at OECD statistics on spending on early years and childcare, the UK is near the top of the league. I mean, it's not that we spend little on this, and the question is whether we're spending it effectively. The OECD statistics include, I think, one of the reasons we look so high, and we haven't included that in our 7 billion number, they include reception class, because most countries don't actually start school until a year after the UK, so they include reception provision in their numbers. But if you include that, we spend considerably more than the average on this. So I think starting from the presumption that we're spending a lot less than most countries is not right. Now, there are some countries that have rather higher provision. Now, one of the things may be that this is, that there is again, the short-run effect may be smaller than the long-run effect in terms of labour supply. But you're quite right. It is very difficult to disentangle what's going on in the Swedish economy, which are all sorts of things are different from what's going on in the British economy, and how much of that has to do with the way that childcare is provided is a very hard thing to disentangle. So the evidence that we're talking about lacking, as it were, is looking at changes in policy within countries rather than trying to distinguish the effect of something in one country relative to another.
Jean, to be followed by John.
Thank you. I have to say, Mr. Johnson, I find this quite gloomy reading, but also I because of where we are, I see the differences between Scotland and the Scottish Government and the Westminster Government. I mean, currently, I understand that we're the fourth most unequal society in the world. Do you think that, given the years ahead that are forecast here, that we might be moving into rapidly becoming the third or second most unequal society in the world?
I don't know. I mean, it depends on your measure as to kind of quite how high up the inequality scale the UK is. It clearly is a relative. There clearly is a relatively high degree of inequality in income. It's worth noting, though, that the Scandinavian countries have much higher inequality in wealth than we do. So there's even the Scandinavia isn't sort of super equal. It is much more equal in terms of income, but it's actually very unequal in terms of wealth. So it depends what you're looking at. I mean, we have very unequal wealth as well. So yes, we do have relatively high inequality. Partly, I mean, that's significantly driven by very high levels of income at the top 1%, the top 0.1%, which we were talking about earlier. Now, what's happened to inequality over the last, so thinking about the future, let's think about what's happened over the last 30 years. So inequality in the UK rose very, very dramatically in the 1980s. Not because incomes at the bottom fell, but because incomes at the bottom were steady and incomes at the top, and actually right the way up from the middle towards the top, continued rising. So there's a very, very big increase in inequality in the 1980s, though that was from historically low levels of inequality in the 1970s. What happened in the 1990s and 2000s was actually across most of the distribution, not very much. And actually through the 2000s, there was a little bit of a reduction in inequality across most of the distribution, but a continued pulling away at the top 1 or 2%. So depending on how you weight that top 1 or 2%, inequality as a whole rose over the 2000s. What's happened since 2007? Well, it looks like inequality has actually fallen a bit. Now, why has inequality fallen since 2007? Largely because wages have fallen, and wages are earned by people in the sort of higher half of the total income distribution, because people at the bottom don't earn. And at least until last year, benefit cuts weren't really beginning to take effect. But benefit cuts are now beginning to take effect, or have started to take effect, and will over the next couple of years. So I think our view is that inequality will rise over the next 2 or 3 years as wages start to rise, so helping the people towards the top half, and benefit cuts start to hit people towards the bottom. So our view is that inequality will start rising over the next couple of years. Probably by 2015, inequality will be not very different to where it was in 2007 or so. What happens thereafter? Well, if the top 1 or 2% continue to pull away, then inequality will rise further. And if, for example, the government implement the 12 billion of welfare cuts that they suggested that they're looking for, then that will clearly have a negative effect on incomes of people towards towards the bottom of the income distribution. So we haven't done this analysis, but my guess is that the thrust of your question is probably right, which is probably that inequality will continue to rise over the next small number of years.
And can I ask you if the Institute, if you do any calculations on these projections after potential constitutional change in Scotland, so that you're looking at a very different set of figures?
In terms of inequality?
No, I mean generally.
So, sorry, could you...
Generally on the budget. Obviously it will be a very different budget if Scotland's system is removed from it. Is that not something that you are concerned with?
So yes, from the UK point of view, you mean? So yes, if you remove Scotland from the picture, so Scotland is less than 10% of the total UK picture. So the overall picture how much it changes will be constrained by that, and it will also be constrained by the fact that the fiscal situation in Scotland itself is not ever so different from the fiscal situation in the UK as a whole. Now, there were a number of years when the fiscal situation was a bit better in Scotland because of North Sea oil. Looks like it's probably a little bit worse at the moment, but in terms of the scale of the UK budget, we're talking 2 or 3 billion, which is out of a deficit of 110 billion. I wouldn't say 2 or 3 billion is neither here nor there, but it's not a very big number. So I think over a 5-year period, the UK budget, if there were an equilibrium situation in which Scotland were outside of it, it wouldn't actually look terribly different.
Just a small point, but earlier on you talked about the 0.01% of people who are the very, very wealthy who contribute enormously, and the 0.10% of the wealthy the 10% of income tax received from the 10% of the wealthy. Given that you also said that they, and it might have been in last night's presentation rather than this morning, but you did say that they, of course, live mostly in London. But you did highlight the considerable difference that makes to the tax income. I guess at a stroke that would make Scotland more equal.
Yes. Yes, Scotland is more equal than England.
Given the differential in these incomes.
Yes.
So, will there be a point when you will actually calculate a budget or look at figures without the Scottish economy?
I mean, in a sense, it would fall out relatively straightforwardly from things that we've done. So yes, we could do that. But as I say, I don't think it will make, in terms of the UK budget, it will make a small difference.
Would you accept, though, that a number of the issues that are raised in this paper are actually quite different policies, given, for example, housing, that will make a difference to the Scottish budget, but in this paper is not relevant?
Yeah, so the Scottish budget is the way that Scotland spends its budget is very different to the way that the rest of the UK spends its budget. So very, very much higher spending on things like housing, agriculture, enterprise, transport and so on. Very much higher spending in Scotland than in the rest of the UK. So the Scottish budget does look very different to that of the rest of the UK. But if you look at what I was talking about in terms of small differences was if you kind of net out the additional revenue that you get from North Sea oil and the additional spending, the difference isn't very large in the kind of at the macro level.
Amy, you wanted to supplementary?
Just in relation to the point that Mr Johnson made about Scotland's current fiscal position not being as good. I mean, you'll be aware that of the Government Expenditure Revenue Scotland reports that are produced regularly. And my understanding was that the last number that were published demonstrate that Scotland's actually been a stronger fiscal position than the UK, equivalent to some £12.6 billion over, I think, a 4-year period.
Yeah. So that's right. So I think the most recent publications for 2011-12, I think we're expecting the 2012-13 numbers out quite soon. And you're absolutely right. For most years in recent history, the Scottish fiscal position, once you take account of North Sea oil revenues, has been noticeably stronger than that for the UK as a whole. But if you take certainly if you take the Office of Budget Responsibilities views about oil revenues in 2012-13 and going forward, then that reverses a little bit, so the Scottish position looks a little bit less good than that of the UK as a whole. So that's what I was saying there.
OBR's projections in oil and gas have been pretty conservative by comparison to other measures. Will you would accept that? There are other bodies out there that have suggested that production will be higher.
So, some of this is now history in the sense that we kind of know the numbers for 2012-13, and they really were quite small. Our expectation is that that will make a big, significant difference to the Scottish position relative to the UK position in 2012-13. In terms of what going forward, I don't know what's going to happen to oil revenues, but I think the key point is the uncertainty and the volatility here. So it may turn out that OBR has been much too pessimistic, but in terms of thinking about the appropriate fiscal policy for an independent Scotland, I think it'll be important to make that robust to the uncertainty and volatility in oil revenue. So in one sense, I think there's a limited amount to be gained from saying, well, I think the number's 4 billion, but someone else thinks the number's 8 billion. The fact is we don't know, and the fact is the budget needs to be robust to that uncertainty.
The oil and gas sector invested, £14.4 billion in capital investment in 2013. They were doing that for a reason, weren't they?
Absolutely. I mean, that's one of the reasons why revenue was has been lower, because that's offsettable against tax payments. So there's I don't know, but I think the key point is that nobody knows, and it will be incautious, it seems to me, to assume that revenues will be at the optimistic end, and if they then turn out to be at the optimistic end, then that's great. But if you assume they're going to be at the optimistic end and they don't turn out like that, then you've got a bit of a problem. And I think it's that. I think the question is, how do you deal with that volatility? And that probably means treating revenues from oil differently from revenues from elsewhere.
Okay, John, to be followed by Gavin.
Thanks. We've obviously covered quite a lot of ground already, so it was just probably to pick up one or 2 points elsewhere. I was interested in your comments on the Help to Buy scheme and the whole concept of helping people buy property, and in the longer term, does that actually push up the property prices kind of artificially and then squeeze people back out again? So there's quite a lot of uncertainty in that area. Is that the reality?
Yeah, I think there are two elements to the government policy. One of which is directly aimed at new properties, and one of which, the bigger of which, is aimed at new buyers of any property. I think there's kind of a number of issues here about why there might be appropriate to have a policy at the moment, and I think the best economic reason for thinking that something like Help to Buy might make sense is that it's clearly the case that the availability of 90%, 95% mortgages has dropped a lot since the financial crisis. And if you think a well-functioning system would provide those, then you might want to intervene in the market to ensure that it does provide those. Now, that I think is more likely to have, that will have two effects. One is it might have three effects. One is it might have an effect on prices. It might push them up a bit. One is that it might have an effect on supply. It might push it up a bit, though that will probably be somewhat indirect. But the third, and I think this is the third effect it will have, is on who it is who is able to afford to buy. And I think this is the other. I think this would be the other rationale for a policy like this is, whilst you can, if you are in a world in which you can only purchase property if you've got a 20 or 25% deposit, then you could think that there might be reasons of social equity for helping those who don't have that, because those who do have it are likely to be those from better off backgrounds who can go to Bank of Mum and Dad for help in doing that, and that there is certainly some evidence of that. So I think actually the economics of the housing market here is quite complex. And what you're actually, I think we need to be very clear about what we're trying to achieve. And you could be trying to achieve several different things here. You could be trying to achieve some degree of social equity. You could be, as I've just described, you could be trying to fix what you think is a problem a short-term problem in the way that the finance market is working. You could be trying to increase the amount of supply. And I think you need to be very clear about which of those you're trying to impact in terms of the precise way in which you'd want to design the policy.
There was some feeling that in the UK we had put too much emphasis on property values and prices and owning houses, whereas in other parts of Europe there's less emphasis on owning and people seem to be more comfortable in renting. And I mean, it seems to me one of the lessons from before the crisis was that people did borrow too much. And I suppose I'd be wary of saying, well, it's a good thing that people borrow 90 or 95% of their values.
Well, I think that, and then I think that, I mean, the question is what would a well-functioning market allow people to do? Now, it may be that we are moving towards a world in which instead of only having to put 5% down, you have to put 20% down, and that's going to be a painful transition because prices will adjust only gradually. You'll get a generation, as we have got a generation of people who are buying much later in their life than they might otherwise have expected. We clearly have a gradual reduction in the level of home ownership over the last several years. You got, for the first time in a very long time, actually quite a sharp reduction of people at particular ages who are homeowners. So I can't remember the numbers, but the probability of being a homeowner at 30 now is much lower than it was 15 years ago. And that you may think that's good or you may think that's bad, but that is a significant social change, and particularly a generational change. The intergenerational effects here are potentially substantial. I think the last thing I'd say is that there has been a significant increase in private renting, but the structure of the tax system continues to favour owner occupation over renting.
Okay, we'll not go in any more with that. Another area I was interested, I don't think we've touched on, is what is driving energy price rises. And I'm interested, despite the fact that there's been so much discussion about that we haven't perhaps got to the bottom of it. And I mean, you specifically mention are prices higher than they should be because markets are not effectively competitive? Are prices being driven up too fast a pace because of the push for secure, low carbon energy? I mean, have we not got to the bottom of that? And I mean, I'm presumably another issue that comes to my mind is international demand. Is it just that China or somewhere is using loads more oil and gas, so that's pushing the price up internationally? Is it because the pound's so weak it's fallen against the euro? Is that disadvantaging the UK prices?
So, I mean, clearly the kind of the biggest underlying cause of why have energy prices, why have electricity prices risen over the last 4 or 5 years? It's largely been driven by increases in cost of gas and other fuels. That the question then is, what about are there other things that may be causing problems? So clearly, green policies are increasing the price of energy relative to a world in which we didn't have any of those policies. On the other hand, taxes on households are very much below for either what taxes on business energy use by business are. They're lower than they are in most European countries, and they're not very close to what the government says it thinks the social cost of carbon is. So if you think that a consistent carbon price is an important part of a response to climate change, then we're not very close to that. So actually, in that sense, taxes are lower than they, quotes, ought to be. But the costs of having higher prices of energy are very obvious, and we had the earlier discussion about the impact on people on low incomes. So as with all of these things, there's a trade-off on that side of policy. So that's one bit of the policy. The other,
oh, actually. In one sense.
In one sense. I mean, I'm not going to sit here and say they're too low, but in the sense that if you had a consistent carbon price, they would be higher than they are now.
Right.
But they will rise over the next several years as the energy market reform effects come in, because that will increase the price of electricity in order to create wind power and so on. And that is a part of the policy that government is pursuing, and there is a trade-off between the impact on prices and the efficiency with which we reduce carbon emissions.
Question that, if that wasn't there, would the prices be falling, or would they still have risen over the last few years?
They would still have risen over the last few years. They wouldn't have risen quite as much as they have done.
Right.
But you know, those policies are a relatively small part of the total rise. And then the second part of the question, which this chapter was more focused on, we've written quite a lot more about the sort of green taxes in the past, which it doesn't come to a very clear conclusion on, in a sense, is the, you know, given all of that, is the energy market working well? And actually, that turns out to be a very difficult question. I think one of the things that, you know, we haven't had up till now is a comprehensive market review by the Office of Fair Trading, or will be the Competition and Markets Authority. It may be that there is a case for that, because, you know, we really do remain remarkably ignorant, actually, about the extent to which this is a genuinely effectively working market. In terms of a lot of what you see in terms of the outcomes, in terms of, you know, what prices are we paying relative to other countries and so on in Europe, it doesn't look too terrible. I mean, the prices we pay in the UK are not higher than they are in most other parts of Europe. But that's not to say that everything is working as well as it could be by, you know, any manner of means.
That's extremely interesting. And the final area I wanted to touch on was your comments on pensions. And I mean, there seemed to be a suggestion that you know, perhaps the tax system and the fact there's no NIC on pension contributions is distorting the market a bit. And I mean, going back to points that have been raised earlier, maybe distorting it in favour of those people that can afford to save. But I suppose, on the other hand, we don't want to discourage people saving, because my gut feeling is people aren't saving enough at the moment.
Yes. So what we wanted to so there have been some significant reductions in the generosity of the income tax treatment of pensions, particularly for very well-off people over the last few years. And we wanted to look at the question of the extent to which the tax treatment of pensions now looked appropriate or not. And I think our view is that the income tax treatment of pensions is not too bad at the moment. It's probably more generous than it ought to be in terms of the availability of a tax-free lump sum of over £300,000. That seems to be quite hard to justify. The income tax treatment otherwise looks pretty sensible. You don't pay tax as you put it in, you pay tax when you take it out. That's actually rather a good way of taxing savings. But the national insurance treatment really does look remarkably generous. So if my employer pays me money, then they pay national insurance on it and I pay national insurance on it. If the employer puts money into a pension, there's no national insurance paid, and then of course there's no national insurance paid on the way out. It's by far the biggest bit of remuneration which escapes national insurance contributions altogether. So I think if you were to look at significant changes to the way in which pension saving is taxed, then it will be in the way in which employer contributions are treated for national insurance contributions. Now, there are obviously there'll be big downsides of doing this. Any tax rise will have negative consequences, but actually it seems quite hard to think of a very good reason why you wouldn't pay any national insurance contributions at any point on employer contributions. Of course, if you're not lucky enough to have an employer putting the money in, then you do have to pay the national insurance contribution. So there's also
is your gut feeling that that would be favouring people at the top end of the scale? Or not necessarily?
Not necessarily. I mean, it's favouring people whose employers put money in, which is probably outside of the public sector. That probably is people towards the top end of the scale. In the public sector, it's much more even across the piece.
Okay, thanks so much.
Alvin.
Just a couple of brief ones, thank you. Going back to Mr. Chisholm's question about the link between high-quality childcare and parents' employment, just for clarification, were you saying that there's been no work done on this at all that you're able to find from a UK point of view, or were you saying that there's work being done but actually the results are inconclusive? Which one of those two were you?
There's not very much work that's been done, and that which has been done is inconclusive.
Okay, fair enough. And the other thing I wanted to look at, Mr. Hepburn asked a couple of questions about oil revenues. Were you saying that the figures for 2012-13, which I guess will be formally published in JARS next week, you're saying they are below 11-12?
If my recollection is correct, I think that's true. I think I have a chart in my head which where the line's coming down sharply. I think that's between 11.12 and 12.13. But those numbers are in the public domain.
Okay. I mean, we'll see JERS next. But another thing your organisation said yesterday, and I don't know if it was a press release, I think it was described as an observation, but you also said, with the vast majority of payments already having been made for 2013-14, the Scottish Government forecasts for this year also look to be too optimistic. So I just wonder where you were getting the figures for 13-14. Are they publicly available, or is that...
These are things that are published monthly by the ONS and also published by the OBR, which show month by month the amount of revenue that's coming in from all the different bits of revenue streams. So you see month by month how much comes in from the North Sea, and those thus far this year, and it may turn out we have a couple of very, very good months towards the end of the year, but thus far this year they've come out not very well.
Okay, that's all. Thank you.
Okay, thank you. That concludes questions from the committee. I'm just wondering, Paul, if you have any further points you want to make to the committee at this stage?
I don't think so. I think we've gone through that fairly comprehensively. Thank you very much.
Yes, well, thank you very much. Really appreciate you coming up and also for comprehensively answering so many of our questions. Thank you. That being the end of today's session, I'd just like to thank all members for their contribution. Just before you all go, I'd just like to say that the draft budget will be before the October recess, which is what the committee had pressed for, so I think that's a very positive development. Thanks everyone.